So a decumulation phase as India ages, as we approach an era where the young India gives way to slightly elderly India, we need to have a framework in which we have products, bouquet of products in fact, not just annuities, which can be chosen and the maximization of the income stream that lasts the subscriber throughout their period. The whole context of reimagining decumulation phase has been taken seriously at PFRDA, and we have been engaged in some kind of a financial modeling also to reimagine some of the schemes that can be launched in the country. And doing that, we have a presentation. It's a curtain raiser on the 3 schemes that we have modeled. So we have a small presentation by Mr. Pradipto Chatterjee and Aditya, which outlines 3 pension schemes. First scheme is basically reimagining the existing scheme with the annuities and the SWP. The second scheme is basically inspired from the UPS that has been recently launched for the government sector. So the thought is, why not the UPS for the private sector as well? And how we can do it without involving the government, by involving maybe the private players and the other players in the market. And the third one is even a bigger framework that basically intends to build a marketplace for the pension credits. Now, pension credits being the units which can be sold and purchased in the market, accumulated to have a running income stream during your non-productive life or post-retirement life. So we do have a presentation by these 2 young officers of PFRDA. Pradipto, please.
Good afternoon to everyone. Very warm welcome to all the people present over here, and a big round of applause to all the people for celebrating this NPS Diwas, a day for pension planning. Thanks a lot. So as ma'am and Jagdeep sir have already set the tone of this presentation, let me just jump into actually what is the background, why we started off thinking in these lines. Now, if we start to build up a Darwinian time scale of the pension schemes that have evolved over the years, we can move from the defined benefit to the defined contribution, and in between we had that defined ambition, and now with the UPS we are getting into a different zone of the assured benefit. Now, with this presentation and the pension schemes, which as in the form of a consultation paper we have already uploaded on the PFRDA website, I would urge all the people, all the stakeholders, not only the pension fund managers, the CRA, as well as the subscribers, should go to through that consultation paper so that we are able to get some good feedback, comments on it, how viable are these things. Provided now we get into why is the need for this new pension scheme is required. So now in the present framework, in the present milieu, the subscribers are looking at flexibility. How much I want to invest, when I want to invest, and is there a direct correlation between what am I investing and what my pension is going to be? That is the basic question. How much pension will I get? This question is actually the answer we are looking at through the 3 pension schemes that we are proposing through our consultation paper. The first pension scheme is focused towards maximizing pension wealth through a mix of step-up systematic withdrawal plan and an annuity. Second one, in which we have a target pension. Along with that, there is a periodic inflation adjustment. And the third one is an innovative concept we introduce as the pension credits, which is based on the idea of the goal-based investing, where each credit has a fixed monthly payout linked to a fixed maturity value. So let us understand what these things are. First of all, the key features. I promise you that I'm not getting into much of the technicality and the mathematical portion. We are trying to explain all these concepts mostly in the form of visuals and graphics. All the mathematics involved in it, the assumptions that we have taken, the calculations, they are already uploaded in the consultation and paper, and I would urge all the people present over here to go through it. Now, towards the first pension scheme, the framework, it operates within the present NPS framework. There is no assurance of a pension wealth or benefits. But now there is a desired pension. The person, the subscriber himself chooses how much pension he needs at the end of the period. Then there is accumulation period. We mention it as minimum 20 years, but there is no maximum limit. However, whosoever enters into this scheme has to be minimum 18 years. Then the investment pattern will be followed by the balanced life cycle fund, where 50% of equity till the age of 45 years, then tapering thereof. And the funds, the pension funds themselves decide how do they want to invest the funds in. The basic contours, the outlines of what the instruments can be selected will be selected by the PFs, but how they want to ensure the mix, that is the decision that the PFs have to take. And the payout structure, initial SWP 4.5%, increasing by 0.25% per annum for the first 10 years. As such, it keeps on increasing till 70, and on 70, whatever the corpus is at the end of the 70-year period will move into an annuity plan and will be a 20 certain year annuity plan. That up to 90 years, the payout will be made. If he predeceases the subscriber, it will be made to the nominees. So just to give you a context through a graphical representation, we divide the entire person's life into accumulation period and an accumulation period. The middle line we call as the retirement line. Let's take a basic assumption that this person requires a monthly pension required of 50,000. So the corpus required, based on a simple calculation, 4.5% SWP, approximately 1.33 crores at T25 when he or she is going to retire. So what is the monthly individual contribution that is required? We get it at 14,466 rupees per month. So this is a basic simplistic assumption that we are taking, that this person, without increasing his contribution for the rest 25 years, contributes regularly for 14,466 rupees. So the SWP, when he retires, increases in this manner. Starts off at 4.5%, goes up to 7% till the age of 70. At 70, the entire corpus which is lying in his name moves to an annuity plan, and the annuity plans runs till 90. This is the basic plan that we are looking at. Now towards the second pension scheme. Almost like the same, except for the fact that apart from the fixed pension plan, we introduce a function for factoring in the inflation. Now the framework, as usual, it is in the NPS framework. Then the subscriber defines his pension, and the inflation factor is calculated using CPI-IW. Then the accumulation phase, same, minimum 20 years, there is no upper limit, but at the age of entry, it has to be minimum 18 years. The decumulation phase, we are considering for 25 years. The pension passes on to spouse, then to the family as per the extant NPS guidelines. The investment pattern, there will be two pools, one fixed and the other one which will take care of the inflation part, which is pool 2. So the risk management, we are proposing that it should be held to maturity to shield the market volatility, and a liability-driven investment during the decumulation phase. So how is it going to work out? Let's look at a diagram. And in the similar manner, accumulation phase, let's the basic assumptions. We are continuing with the same assumption we started off with the first example, 50,000 per month. Then the pool 1 scheme, we require a 1.33 crore corpus that we calculated last time also. However, when we introduce the function of the pool 2 to take care of the inflation part, the pool has to be jacked up. So it increases by approximately 0.39 CR. So the total corpus that you require when you retire is approximately 1.72 CR. Now this has to be factored in, that how much money you have to contribute on a monthly basis. We calculate that. At the last time when we saw that it was around 14,466, now it is jacked up to around 20,600. So if you can understand the fact that when you retire, if you are looking for a constant pension payout, there is no problem at all. But the moment you figure out that you have to factor in the inflation also, the contributions have to go up substantially. So, and now what happens at the retirement? This line clearly gives you whatever annuity you buy, it gives you a fixed pension component, and the inflation part, the pool 2, it gives you an additional pension which takes care of the inflation part till your 25 years. So these are the two schemes that we have talked about. Now I would like to invite my friend over here, Mr. Aditya Maruti Magdum, to take care of the third pension scheme. Thank you.
Thank you, sir. The third pension scheme is an innovative product called the pension credits. With the pension credits, we want to bring in a market tradable product which will provide you an assured pension benefit. The current structure of the pension credit focuses on goal-based investing and behavioral finance. The focus here, we try to shift it from the question, how much corpus do I need, to how many credits I need to get to acquire my target pension. It is a form of a gamification. So a pension credit may be defined as a notional financial unit. It's a financial instrument which assures a fixed monthly pension payout of rupees 100 for a specified period post maturity. A pension credit shall have an accumulation phase, a maturity, and a decumulation phase. First, let's understand the subscriber's end, what inputs the subscriber will have to give, and those inputs, what he will receive from the pension fund side. So from the subscriber's end, as you can see, we only need 3 inputs: the year of his retirement, the target pension that he desires to receive per month, and the choice of scheme. So here we want to throw the floor open to the pension funds to decide which type of schemes they want to run. For an example here, we have taken something similar to what we have in our life cycle funds, which is the conservative, the moderate, the aggressive, and a debt focused scheme, which will only have corporate bonds and government security exposure. In this example, as you can see, a subscriber is choosing a year of retirement of 2036 with a target pension of 1 lakh rupees, and he has chosen an aggressive scheme. So basis his choosing for his assured pension, what inputs he'll get from the pension fund. So if you can see, the first thing, here we are saying PF1, that would be the name of the pension fund. Second thing is the pension credit which will be available. We have come up with a nomenclature. Of course, we are open to inputs on this, and this can undergo change. But here PF1 36A3, here PF1 denotes the pension fund, 36 denotes the year of maturity, A denotes aggressive, and 3 denotes how many years after maturity in the decumulation phase will the pension credit pay out pension payments. The next thing that you can see is the purchase price, which will be 1465 in this case, which we have arrived at using historical returns for the past 10 years of various schemes managed by our pension funds. And the pension credits required, that would be 1000. So here the question arises, how does one arrive at the price of a pension credit? For this, we'll get back into the operational structure. So as I said before, there will be an accumulation period, a year of maturity, and a decumulation period for a pension credit. As you can see from the blocks in the decumulation period, P1 to P12 denote 12 monthly payments in the decumulation period. So the present value of these cash flows on any given date will be the performance neutral price of a pension credit. Can I next? So here you can see that the example says T0 to T5. So this is a pension credit with 5 years of accumulation, and post maturity it will pay out a 1 year of pension of rupees 100 per month per credit. Now we understood that the performance neutral price, which will be arrived at using the present value of the cash flows of the pension, will be based a long-term rate of return that will be come up with by the pension funds basis their internal projections. But given factors like volatility, sidewards markets, or changing interest rate scenarios, it might not be possible to achieve that return. So in such a scenario, we'll have to think about ways of how to lever this price upwards or downwards basis the performance of the pension fund, one. And second thing is how we'll have to lever the price with respect to the asset allocation strategy, which is if it's an aggressive fund, then there needs to be a higher buffer on the price of the pension credit. Second thing is, which we need to discuss, is the secondary market structure, which we are envisioning at this stage, and we are open to discussion, and we would like everybody's inputs on it. And the world is an oyster, we don't know how it will turn out. So getting into that. Yeah. Like we discussed, the pension fund will have to or may have to come up with pension credits with different calendar years for maturities. So 2036 maturity, 2037 maturity, 2038 and so on. So basis the pension credits that he's accrued which mature in that specific year, he will receive a commensurate pension every month. If a subscriber wishes to increase his pension at a later stage in life, he may so choose to buy credits which mature in that specific period so as to get a bumped up pension in that phase of his life. Now let's talk about the performance levering. So there might be scenarios that for example, in the previous pension schemes, we assumed a 8% long-term return for simplicity's sake, for simplicity of illustration. There might be a different rate for different periodicities to arrive at the price. But the pension fund is unable to deliver the return, and the actual return does not match the spot rate that was taken at that point in time. So the price of the pension fund pension credit will need to be bumped up in order to ensure that the funded status of the pool, which will be funding the pension after maturity, is met. On the contrary, if the pension scheme outperforms, then the price of the pension credit will have to be levered downwards. The detailed mathematics along with illustrations we have covered in our consultation paper. The second angle is the risk-adjusted price, like we said, based on the asset allocation strategy. For example, here we have taken that for an aggressive scheme, we might use a 10% markup on the performance levered price of the pension credit, which will be arrived at by the pension fund. For a moderate, the premium might be 5%. For conservative, it might be 2.5%, and so on. Now let's talk about the secondary market structure. So we understand that it's a cash payment structure where there's periodic payments which are coming into the picture. But the way we envision it now and the way we put it across in the consultation paper, we envision a ETF style structure. Those who are aware, they might look at the diagram and will identify it very clearly. We envision that the pension fund themselves might act like a market maker, or they might empanel authorized participants, which will ensure that the price of a pension credit trades closer to the risk-adjusted price. The buyer and the sellers can interact and sell and buy pension credits in the market on a secondary market platform amongst themselves and with the authorized participant. So this is just a visual representation of how a subscriber might see the screen when he enters the secondary market platform. For simplicity's sake, we have only taken 2 pension funds. So here we have taken an aggressive pension credit with a 3-year payout, an aggressive pension credit with a 5-year payout from pension fund 1, and similarly from pension fund 2. Now, basis their past performance, the price of the credit might vary from the performance neutral price. And that is where the subscriber will have an angle to choose as to which pension credit he or she can buy in order to lock in his target pension. So it makes the entire pension landscape extremely competitive as well as lucrative for the subscriber to choose how and when he wants to get how much pension. That will be all from our sides. The consultation paper is live on the PFRDA's website. We urge everybody to please take a look and provide us with your inputs. That would help us to understand if something like this is desirable for the market and feasible for our pension funds to provide. We would like inputs in this regard. Thank you.
Thanks a lot. Thank you. Thank you.
Thank you so much, Pradipto and Aditya. So that was a very detailed presentation. So as they said, we already have the paper live on our website. It is under the Research and Publication tab. And the comments are can be provided by 31st October of this year. And we really look forward to the comments of the academicians, the industry people, the scholars, the researchers. Of course, we have a big variety of intellectuals here on our panel today, and we also look forward to their inputs on the schemes that we have discussed today. Perry, I think you worked extensively on the first 2 models. Would you like to comment on those 2 models, please?
These are basically blended solution kind of thing, where depending on the requirement of the subscriber, ultimately we need to provide a solution to the requirement that the person is looking at. Now, when I talking about a subscriber, I have to put myself into his shoes as to ask a question as to what I'm looking at my retirement, what I'm expecting my life to be. So if I want a targeted pension or a desired pension, then I need to look back and plan accordingly. The basic purpose of the whole solution is going to be plan for yourself. Then enjoy that particular payment till certain age. Basically, in the first pension scheme, we spoke about a simple systematic withdrawal plan or a phased withdrawal with a incremental increase from year to year basis for the first 10 years. Basing on the Indian demography, now 60 to 70, I might be very, very healthy and I will be able to go around and perform my all activities. Post 70, the people may not be that sure as to what is going to be my physical, mental and other things. Even though I might be active, but still, I would not like to look at the vagaries of the market or whether how the things are moving on, etc. In such a case, we thought that it is better to blend a 20-year annuity which is certain and uncertain and which also provides a good rate of return even in the current market scenario. Basically, when the person touches 70, then he is assured with a certain amount throughout for the next 20 years. Now, the person would also be thinking of the family. Now, at the age of 70, if something happens, God forbid something happens to him, his family also need to be tended. So that's how this particular product, what it does is up to 20 years, it guarantees the same pension for the next 20 years. And if he survives this 20 years, the person who has bought the annuity, he survives beyond this 20 years also, the pension keeps on paid to the particular subscriber. So we try to provide a blended solution so that when I'm active and when I'm able to do a little bit of more into equity kind of thing with a growth pot and other things, then that requirement is met. But post certain age, when I need to be more a little bit of a conservative or may not be directly involved into the looking at the various investment strategies, etc. So we thought that it should give you a proper balancing effect between the requirements. That's how we try to structure it. It's a simple product, but everybody knows we thought that it should be a blended product would be much more beneficial to the subscriber. Second thing, in the second option, even though the world is moving from assured or a guaranteed product kind of thing to a DC, we structured saying that we need to evolve somewhere. The world is also moving towards hybrid products rather than a simple DC or DB. So somewhere something has to be met based on the expectations of the potential customers. There also again, it's basically, the idea is that I should, at the beginning itself, I should be able to estimate myself as to what's going to be the liability over a 25-year period, including the taking care of the inflation component and also certain buffers. Then try to work backward towards what is going to be the monthly contribution. So in both of these schemes, we are trying to move away from the traditional thing that I need to have I'm going to withdraw a cash component, a part of the cash component, and also I will invest only a part of the thing into my retirement solution. Because if I do that particular iteration, the contribution rate is going to be very high. But if I have to put the contribution rate also within the manageable limits and also provide a blended solution, we thought this is a better approach. That's how the second pension scheme has been designed. Thank you.
Thank you so much, Perry. I hope to get a lot of responses on these two schemes because these have been in the market in some form or the other and are familiar in the insurance industry and in the pension industry. It is the third scheme which is quite, I would say, path-breaking in the sense that it tries to set up a new paradigm for the subscriber because we have introduced a concept called pension credits. Now these pension credits, the subscriber can build up these pension credits, a bouquet of these pension credits by subscribing to various schemes, to various pension funds of various tenors, and he can actually visualize what his income stream would be at the end of his, when his retirement period starts. And now when these pension credits can be built up, they can also be sold and purchased in the market. So we are also envisaging these pension credits to have a primary market, that is the issuer is maybe the pension fund, and also a secondary market where they are openly, they are actually exchanged, bought and sold, and there is a price that is determined through the market mechanism. And so this is quite a paradigm shift, and what we have attempted is innovative. It may not be perfect, but it is certainly innovative. And therefore, we need to evolve after consultation with all the industries and academicians. So we will look forward to the comments and also, have a partnership in evolving all these three schemes and many more, in fact. These are only the prototypes, and there could be many more in future. So thank you, Perry. Now I come to Arora sir. Sir, you have worked extensively in the insurance sector, and you have also worked extensively in the annuities. So annuities have been able to provide a hedge against the longevity risk, because they cover the entire period of the subscriber and sometimes even their spouse, and also give return of purchase price to the children. And so that way longevity risk is covered, and there is also certainty of income. But we also know that, now the interest rate scenario is falling, and therefore there is a concern about the, the rate of return that we are getting in the annuities. So that is one concern. And so it does not hedge you against inflation. So according to you, so in the falling interest rate scenario, is that a constraint to develop new decumulation products? Is that a constraint? And what do you think? We don't have depth and instruments in the market. So is that also a concern for this kind of a decumulation products? So your views.
Good afternoon, everybody. And congratulations and best wishes to PFRDA on celebrating NPS Diwas. Now, coming back to the question, there are 3 or 4 issues raised. Deaccumulation phase, low interest rate, depth of the market, and pricing challenge. So, I'll tackle all these parts separately. First, deaccumulation phase. When we say the accumulation phase has ended and deaccumulation phase has started, it means lump sum is now available for transfer to the annuity provider. And a new contract is entered between the annuity provider and the subscriber, right? So it is a single premium. Lump sum is available. Single premium is transferred. So when the lump sum is available, it is easier for an actuary to take a call on the interest rate, because there is no time lag between the receipt of money and the investment of money. If the money is received today, it will be invested at the most tomorrow or day after tomorrow. Not beyond that, because the moment the money is received, the meter starts. Annuity has to be provided. For each day has a cost. You cannot keep the money idle. It has to be invested immediately. And actually knows what is the interest rate prevailing in the market. The interest rate which is prevailing now in the market is likely to be same. There is not expected to be much volatility in a day or two. So he can take a reasonable call, and it is possible to price the annuity product with a single premium with the realistic assumption. Now compare this with the regular premium payout. When the premiums are received regularly, not as a single premium, then what happens? It is difficult to take a call what will be the interest rate after 10 years. The premium which is received after 10 years or 12 years or 15 years, at which rate it will be invested. So when the actuary takes a call on that interest rate, he builds in some margins. And when margins are built in, the return to the policyholder, return to the annuitant comes down, because he has to take care of extreme volatilities. The insurer has to take care of that. So when we are talking about deaccumulation, it is single premium and it is manageable. The actuary can always manage the challenge of pricing in a single premium product. Right. Now, when the contract is entered into, what type of liability the annuity provider has in its books? Now, he knows the amount is to be paid every year. That amount is guaranteed at the time of inception. It is guaranteed. So he knows this is the amount which is to be paid every year. And then in India, most of the annuities have the feature of return of purchase price at the time of claim. So the final amount is to be paid. So he knows the amount. So liability is guaranteed in monetary terms, and it is not at the inception. It is known at the inception. But for how many years the annuity will be paid, and when the final payment will happen, that is uncertain. So duration is uncertain, and final payment timing is uncertain. So when I told that interest rate can be managed in a single premium product, this uncertainty of timing of payment can be managed on a portfolio level based on expected experience of longevity. So it is possible. Now we have talked about the depth of the market and the low interest rate scenario. Now you see, the benchmark security is 10-year GSEC rate, which is most liquid security. And from 2003 to 2024, if you see the closing price of 10-year GSEC for all these 22, 23 years, what has been the minimum rate? Minimum rate was 4.99, and it happened only on one day. That was in 2003. What has been the maximum rate? Maximum rate was 9.51%, and that happened during 2008, I suppose, October or July 2008. But what is the range? 4.99% to 9.51%. And the median has been 7.35. If the median is 7.35, it means 50% of the time interest rate on 10-year GSEC security was less than 7.35, and 50% of the time it was more than 7.35. And there was 21% of the days when the interest rate was more than 8%. So this is the scenario. This is the scenario from 2003 to 2024. Okay? It contains some volatility period also, subprime crisis, 2008, and some other crisis. Now, you see the interest rate scenario in the last 10 years, from 2004 to 2014. 2014 to 2024, 10-year scenario. In these 10 years, the minimum interest rate has been 5.73%, and the maximum interest rate has been 8.80%. The range has reduced. The range has reduced, and there is only 5% period, 5% of the time interest rate on 10-year GSEC has been more than 8%. Mostly it is range bound between 6 to 7%, and the interest rate movement shows a mean reversion tendency. Mean reversion tendency, it goes up, comes down, it goes down, comes up. It's a mean reversion tendency. So in this interest rate scenario, it's easier. The only problem for the policyholder is when the interest rate is 4.99%, if he purchases the annuity at that time, his all future payments gets locked at the low interest rate regime. That is the problem. And in this respect, the insurers need to come out with innovative products. Now, this is the 10-year scenario. Now, what happens when the person retires? Normally, he is at 60 years of age. And what is the balance duration? He may live up to 100 years. Very few will go up to 100 years. Most of them will go up to 80 years. Some will remain between 80 to 100 years. So what is the duration? Mostly 30 years, 40 years, not beyond that. And you see in our investment market, the 40-year bonds are available, 30-year bonds are available, 20-year bonds are available. Right now, the longest security available in GSEC market is maturing in 2065. And there are reports that government is considering to issue 50-year GSEC security also. These securities are available, tradable, liquid, and it is possible to invest. Now, what happens when the liability is guaranteed in monetary terms? It can only be matched with the asset which is also fixed income security. And these securities are available. So definitely, all these insurers invest the money received through that deaccumulation phase and any other single premium products, match it with by investment in government securities. But government securities normally, you all know, have a little less interest rate. It's a sovereign debt. There is no credit loss. There is no credit risk, and liquidity is available, so that premium is there. The interest rate is slightly low. So there is another market which is available, that is the state government securities. And state government securities provide a higher spread. Yesterday, I think every Tuesday there is a state government auction. And yesterday, the interest rate was around 7.5%. In the past, the state government securities are available for only 10-year period. Now these are available for 15-year, 20-year, 25-year, even 30-year periods. So by investing a part of the portfolio in state government securities, it is possible to increase the return. Then that takes care of some part of inflation, right? And after that STL, there are corporate bonds. And corporate bonds provide still higher interest rate. But the problem here is that in corporate bonds, it is very difficult to get securities which are of long duration and which are of higher rating. AAA rated, 20-year bond, 30-year bond, you won't get. You get for 5 years. You may get for 10 years, but not beyond. So in this area for corporate bonds, definitely the depth is lacking. It is improving. But for other fixed income securities, definitely depth is there. Then there's an equity market. You see, what is the investment allocation norms for insurance companies? 20%, not less than 20% government securities, not less than another 20% in state government securities, and balance 60% in approved investments. And the entire 60% can be in equity. It can be in debt also. It can be in equity. But still, none of the insurers tries to invest in equity. They only go in fixed income securities and debt, because it's the money which is required for retirees, and their capacity to absorb the capital loss is very less. So nobody goes for equity. But the equity market has its depth, it has its resilience. Very slowly and slowly, we are more dependent upon DII than on FIIs. Right? Even if there are ups and downs in the equity market, we have the capacity to absorb the shocks and come out and bounce back very quickly. Now, this is about investment market. I'll take 2-3 more minutes, because another question was regarding the innovations and deaccumulation type products and options. These 2-3 schemes, the details were given, good schemes. I'll further go into details and when I read the document and exposure draft. But you see, in all insurance annuity products, lot of options are available, and these are not known to public. These are not known to subscribers, and these are very simple and very useful, flexible options. You see, when we say joint life annuity, what we think? Joint life annuity means husband and wife annuity, right? But we have insurance products where a subscriber can have a joint life annuity with child, with brother, with sister, with parents-in-law. All these relations are now possible. Earlier it was not possible. So joint life annuity can be in different relations. It is possible. Secondly, deferred annuity, right? A person retires at age 60. He is having at that time lot of funds, because all terminal dues are paid to him. He may not require immediate monthly payment. He says, I require monthly payments after 5 years, but you take the money now. That is the deferred annuity. Then there are insurance products, annuity products, which provide deferred annuity for 5 years, 10 years, 15 years. You can wait for 15 years and then take the annuity. This is available, right? And thirdly, the return of premium. So when the return of premium is available on death, and when the annuitant dies, when the claim happens, there are options available where the annuitant can say, I don't want 100%, my nominee should not get 100% of return. You give them 50%, balance 50%, you increase my annuity. And he can determine that percentage. Okay, on my death, 75% you return to the nominee, 25% you utilize and increase the annuity. And that can take care of inflation, right? There are many other options, I can go on, but I think there is a time constraint. Thank you very much.
Thank you so much, sir, for telling us in detail the investment strategies that can be adopted by the insurance companies to give a good annuity product, and also about the various annuity products that are available in the market. Sorry for interrupting you because of the time constraint. So now we move on to the online panelists. So we start with Ms. Chitra Jaising, who's also an actuary and has been closely associated and has been a close observer of the annuity markets. So ma'am, the question to you is that India's annuity market, while still at an early stage, offers significant potential for growth, product diversification, and innovation. Drawing on the global practices such as inflation-linked annuities, deferred annuities, hybrid drawdown annuity models, and pooled risk-sharing approaches, what innovation would make the annuity products more attractive and effective for NPS subscribers? In the interest of time, may I request everyone to stick to 7 minutes, please? Thank you, ma'am.
Thank you, Sumit. And I thank PFRDA for giving me this opportunity. And I also congratulate everyone on this NPS Diwas. So quickly moving to the topic. I heard what Mr. Arora ji had said. So what are the current type of annuities which is available? I mean, while he mentioned that there are multiple annuities available, but the most obvious choice which is made by the NPS subscribers are around this annuity for life and the annuity with return of purchase price, and also joint life annuities with 100% return return of for the spouse, 100% annuity for the spouse with return of purchase price. So until being an NPS trust chairperson, so I know that 2 lakh annuities have been sold, and subscribers have around 2 lakh annuities have been purchased till date from the NPS pool. Out of these 2 lakh annuities, 69% have opted for the uh, return of purchase price. The annuity with return of purchase price, and 14% have opted for return of purchase price with spouse 100% annuity, and only 5% have opted for the annuity for life. Now, looking at the returns, so I was just looking at the returns which is available with respect to each of these kind of annuities. Now, if you have a purchase price of 10 lakhs, for an annuity for life, you get around 86,000 rupees monthly annual pension, which turns out to around 7,000 rupees monthly pension, which is only say 8.61%. This is without, it is annuity for life. So if you compare the same with return of purchase price, the annual return is around, annual pension is around 64,000 rupees, which is around 5,300 rupees. Using simple math, the return is around 6.3% or 6.4%. So now typically what a subscriber does, he compares the 6.3% with a GSEC yield, let's say 20-year GSEC yield. Because if I'm 60 years today and I purchase an annuity, I reasonably would probably live until 80 years. So looking at 20-year GSEC paper, the GSEC paper gives a return of around 7.2%. This versus an annuity which is at 6.3%. This is always being compared, and the subscribers feel that the annuity returns are lower. But Mr. Arora ji did explain that this is guaranteed, because when you're going to take a fixed deposit or a fixed deposit, etc., it's annually, it's renewable for a period of 5 years. The maximum deposit you get is for a period of 5 years, and it is renewed later. And what interest you would get is probably much, it is not guaranteed, it can be much lower than what you're getting today. So I think the subscribers need to have an idea of the guarantee part. So now going to your second question, with respect to the innovative annuities which is available globally. So what I found is the deaccumulation phase and the accumulation phases are linked. Actually, globally, the accumulation and the deaccumulation phases are linked. It's not like, you come down and you offer a single premium and you get innovative, different kind of innovative products by offering a lump sum. There is a limitation with extent to the amount of innovative products which you get when you have immediate annuity kind of scenario, currently which we are having today. But having said this, so probably we can look at various popular annuity products which are available today, which is definitely not what today the presentation made by the PFRDA officials, which I think is really innovative, and I would be really kind of looking at it, looking at the paper and looking at the comments. So what I found is there are two broad kind of innovative products. One is the investment linked annuities, other is the enhanced annuities. The investment linked annuities, there are three different types. One is a variable annuity, one is a fixed indexed annuity, and other is the registered index linked annuity. The variable annuities, as the name suggests, it is invested directly in the market. Mostly it is invested in the accumulation phase, and then the funds are invested in the market. It is not linked to any specific index. The returns are accumulated in the fund, and at the time of retirement, the subscriber can choose to take the return which is available in the market. So the problem here is the return is not fixed. It is directly linked to the return which is earned in the market, and the returns can be very high depending on the market performance. It can be negative as well, without when the market is very low. But this doesn't actually fit into the design of a retired person, because a retired person typically wants a constant income. He wants stability. So I think this probably would fit into a person who looks at the annuity as an additional option rather than a main income source. So while it is innovative and it is an option which is available for many people in US and European countries, but it is the subscriber's need which determines whether he needs to go in for a variable annuity or not. So there is another kind of annuity which is the fixed index annuity. As the name suggests, it is linked to a specific index like an S&P 500 or let's say a BSE or an NSE. Again, you have the accumulation phase. The funds are invested, like currently you have the accumulation phase in the NPS, where the funds are invested in a specific indexed annuity. It grows, and when a person comes to the retirement phase at 60 years, probably 65 years, he can choose to get the income based on the index. Again, but with respect to fixed index annuity, there is a floor. That is, there is a protection that your principal will not become zero, or your income cannot be below zero. So the income is floored to a particular level, and also your principal is protected, but your upside is actually capped. There is a cap to the upside. That means you cannot get the 100% market returns. There is a cap to the upside, and there are also charges with respect to spreads, etc. While the subscriber will benefit from the market returns, he does have some kind of restriction, and he cannot get a full 100% market return growth. So that is the probably the downside of the fixed index annuity. Again, the subscriber cannot aspire to have a fixed income kind of scenario like currently what we have with the immediate annuities which is available currently in India. So again, probably we can look at, there is another kind of annuity is really popular in US and Europe, which is the registered index linked annuity, which is a mix between the variable annuity and a fixed index annuity. Again, it is linked to a specific index. The floor is not capped to, it is not floored to zero. There is a kind of partial floor, and there is a partial growth benefit which is available to the subscriber. Again, again there is an accumulation phase. You can use this index at the time of accumulation phase, accumulate his funds, and when it comes to the deaccumulation phase, he can again get some kind of fixed income plus variable return. So this is the registered index annuity, but this is not available in India currently. And I think again, we are also used to having some kind of fixed income. The subscriber should have a mindset not to have this as a main annuity, rather have this as a second option, and he should be aware of the risks that there is a possibility that he will not get a fixed income. So one more, I know I'm running out of time, but I'd like to speak on one other annuity, because the WTM did speak about the health annuity. So there's something called the enhanced annuity. So this is also called the impaired life annuity. So if a person is ill or has some kind of lifestyle diseases, etc., the insurance companies actually can offer him a higher annuity because of the condition he is in, and then probably give a higher annuity, month on month annuities. So given his condition, so the subscriber or the annuitant can enjoy a higher return while not having to wait, not having to worry about the income which may be lower in a typical annuity. So these are the two major kind of annuities which I found globally. But having said this, it's the subscriber who needs to decide the risk and the return. If he wants a higher return, he should be prepared to take the risk. So there is no free meal. If there is a guarantee, there is a cost. And because the insurance companies also need to make money, and when there is a guarantee, they'll always be building a cost around it. As an actuary, we know the guarantees always have a cost to it. So this is what I have to say.
Thank you, ma'am.
Thank you.
Thank you so much, ma'am. Yeah, please.
Chitra, IRDA has recently allowed the index link annuities, and very soon, in the next few months, you will find in the market new products where a part of the subscription is linked to an index. So that is likely to come very soon.
Yeah, that's very excellent to hear.
It's nice to hear that, sir, that we are also going by the global best practices and introducing new products. Thank you so much, ma'am, for expounding so many products that are available abroad and probably can be looked into in the Indian market as well. And it also makes for a study by PFRDA to look into the various concepts that are available abroad and see if they can be adapted in some manner here also. Thank you so much, ma'am. Now we have three more experts from abroad. So first one is Mr. William Price. So he has been with the World Bank and has a rich global experience and is also associated with UK, which has seen a lot of innovations and experimentation in the pension sector, including the auto enrollment. Then they had, sometimes they made the annuity mandatory and then it was done away with. Then they introduced the CDCs for the accumulation and the decumulation phase, then the CDCs only for the decumulation phase. So he has a variety of, I believe, observations on the global best practices. So Mr. Price, my question to you is, what would we be aiming for in the decumulation phase, and which global innovations in decumulation, like variable life annuities or the UK's CDC, do you think are the most realistic to adopt in India over the next decade? And I would request you to stick to the timeline, please. Thank you.
Thanks very much, and thanks for the opportunity. Let me just check you can hear me well. Yep, great. So let me give the answer in three parts. I was going to share some slides, but just for time, let me just, I'll give you the 1,000 words and not the picture. So the first issue I want to raise is choice. And there's lots of issues on product design, which I'll come to, but just to think through the concerns about choice. And what the UK did, I often say, coming from the UK, you have pretty much every triumph and disaster of pension policy. And auto-enrollment, great triumph. It happened more or less the same time as the 2015 pension freedoms, which was an extremely bad policy decision. Before that point, you used to have effectively more or less 100% annuitization. The market wasn't great, and it certainly needed quite significant reform. But what has happened since 2015, now that people can basically make any choice they want? If you look at the number of accounts, now currently 10% of people take an annuity. So 10% of people have an income until death, compared to more or less 100% before. And that's by the number of accounts. And if you look then at the value of the accounts, it's also 10%. So there's a huge number of people who are then facing not having income in old age. If you look at the number of accounts, over 50% of people take all of their money out in one go as soon as they can, or at the beginning. A lot of those accounts are small, and you may say, well, what's the point of having £10,000 when I'm 60? That's not going to give me enough retirement income. And that's probably true. But if that 10,000 remained invested and you took it when you were 75 and it's 30,000 and it's for a much shorter period, it may actually give you 10%, 20%, 30% more income than the base retirement income. So that's one of the issues. By value, about 70% of the money is kept in what we call phased withdrawals, what you were calling the SWP. And you say, well, okay, so a lot of money is still there, but there are two problems. One, self-annuitization, very difficult. No mortality guarantee. Extremely inefficient because there's no mortality pooling. And you'll almost certainly end up with what I'll call the Australian problem, which is when they looked at their market where there's no choices. Lots of people with a lot of money are not spending it because they're so terrified of outliving it that they are rich on paper and they are poor in consumption. And all of this story is, how do I make sure I have income in old age to fund consumption in old age? And I think we really need to, and it's great to hear the conversation that you're having here, we need to reconnect pensions to their fundamental purpose, which is providing income in old age and consumption, as you said, as was said in the outline. And it's a little bit like you go to your health ministry and you say, how have you done last year? And they said, well, good news, we've put all the money into education because that's a really important area. And you think, well, aren't you meant to be spending money on health? And lots of pension systems are a bit like that. So you're accumulating assets, but you're using it for housing or education or medical. Medical maybe in old age is allowable, but you've got to focus this money on how do I get an income. So let me then go to the final part. So what are the innovations here? What would we do? So as you mentioned, the UK, so CDC, conditional defined contribution, only one scheme has it. It's been legislated. But in reality, what it's essentially doing is saying, well, the Dutch system was very good. And what that is doing is saying, I have an asset, I'll invest those assets, and I'm going to pay you an income. But every year, when I work out whether I'm going to pay you more income, it will depend on the funding. So I'm going to aim for a certain level, let's say inflation. If the assets are returning well, I'll give you that inflation. If they're not returning well, then I'll give you no inflation. And so there's a risk sharing there. But if they're doing very poorly, I'm going to cut your benefits. So this is cutting the pensions in payment of a pensioner. And the Dutch system actually worked fantastically well for 30, 40 years, actually more than that. But it became, the global financial crisis dealt a severe blow to it. And it was the politics which meant that people came back. And so India, I think you're in a kind of quite a difficult position because of the successful economy over the last decades. Because it's difficult for you to look into the thoughts of, well, what happens if we're Japan or if we're in the Netherlands or we're like a European economy which has a massive shock? Because I would test the innovations that you're coming up with on the Dutch experience, because they have basically got rid of what was an incredibly well-designed way of having risk sharing and decent pensions. If I were in my final minute or so, what we've done, thinking through all of these issues for decades and working out, annuity markets fail for lots of the reasons already given. They're high cost, there's lots of fees, they're not very good for people with poor health, and so the enhanced annuities are very good. We'd sort of basically, if you had to come up with a single thing, I would go for a form of variable annuity, definitely pooling the mortality, because the pooled mortality is a very strong benefit to make sure that all of the money is going further. It's much more efficient than self-annuitization. Keep the assets invested for much longer, and then have forms of smoothing of those payouts. Our modeling shows you'll get on average about 25% extra. There is a downside risk, a small downside risk, but the cost of trying to avoid the very small downside risk in terms of lost income, particularly for lower income people, is too high. And so the question is, you would go for some form of guaranteed payment until you die, but with variability in payouts. So let me stop there with a final comment in terms of choice. If you look at the latest figures in the UK market, 70% of people of those 10% who choose annuities, 70% have a single life, 80% have a flat nominal. Could be that they've worked out some beautiful math that makes that's right for them. I would say I'd bet my house on the fact it's because that's the one that gives them the highest upfront payment. And yet pretty much 100% of those people will have a spouse or some partner, and all of them are exposed to inflation. So the vast majority of people are choosing products which exactly, A, are terrible for gender equality because there's no joint life, and B, have no inflation protection. Great if that's the right answer for you, but just be very careful about politics, choice, and as I say, I would have some form of variable annuity.
Thank you so much for giving a detailed explanation to our question. Now we move on to Mr. Kulin Patel, who's also an actuary and has been associated with the pension products for the corporate sector, if I'm not wrong. And the question for you is, in the context of the decumulation phase of pension, how do you view the implications of decoupling longevity risk? I think it's the longevity risk that brings down the returns on the annuity. That's one of the biggest reasons. So if you decouple the longevity risk from the traditional annuity structure, particularly when annuities are managed as pool funds that inherently rely on cross-subsidization among members? What alternatives, frameworks, or innovations would better balance individual equity with collective risk sharing? Mr. Patel, please stick to the timeline.
No problem. Thank you very much indeed again. I'll just dive straight into it, Sumit, for the time. So again, we've got 2 or 3 perspectives that the question has raised. Let me start with the risk cross-subsidization and the longevity risk decoupling. Chitra very nicely outlined that between 70 to 80% of the NPS exits at retirement have chosen a return of premium. Aurora-ji also mentioned that from a broader retail perspective. Now, when you have the return of premium, from an actuarial perspective, just building upon what Aurora-ji mentioned, the subscriber has already decoupled the longevity risk. The subscriber or the annuitant has protected themselves. There is now no downside for the subscriber. They are getting the lump sum of the capital back, and also they have the protection of the lifetime income if they outlive the average mortality. But the insurer, who is at its base core fundamental trying to pool the risks, is really left with having to protect that longevity only. And so we are in a situation where already that decoupling has happened. So we need to ask ourselves, with all of these fantastic innovations, ideas, experiences around the world, and the work, of course, that a PFRDA team is doing, is why is that? What is it inherently in that is making the subscribers want that assurity, want that bequest motive is so strong? And the reason I highlight that is that in any risk pooling, and Mr. Price, Aurora-ji have mentioned this, at the end of the day, for that risk pooling to work, you have to have skin in the game. And if you want higher upside, but also at the risk of low downside, you need to have that skin in the game. So I think we need to ask ourselves, why are annuitants going for that? We have our own theories, but I think any of these innovations, we need to establish that a lot of these require skin in the game. And are our subscribers and our annuitants ready for that? And how do we create the narrative as an industry of these pooling new innovations with that in mind? So that's the first bit of it, as far as the risk and the longevity risk pooling part of it. And I think that lends itself quite nicely in terms of, okay, if we have that construct that people want bequest, people want control, people want also at the same time flexibility that we've spoken the last hour and 20 minutes about, then what are some of the frameworks that are existing and we can look at to see what sort of solutions can be adapted for the Indian scenario? Because of course, we need to consider very clear our Indian scenario. We have wide range of socioeconomic cohorts in our country. We have a lot of wide range of regional, social, and cultural range in our country and diversity. And we need to therefore have teams within the country that might appeal to certain cohorts. And of course, the multi-framework going forward, which will be unveiled later on today, obviously has a lot of that. So what are some of those frameworks that sort of can keep in mind? Well, I think the first thing is that you've got examples like Australia, which from a defined contribution perspective is always held up as the leader in defined contribution experience. But at the same time, we also, and some of the stories there is a little bit of more flexibility has come in the decumulation stage with this systematic withdrawals, but also blended solutions that have control trigger points as to which then annuitization or more traditional routes for protection take over. As Will said, some of the dangers with the Australia model is that the research showed that people are not spending enough and they are sacrificing their lifestyle in the fear of running out of money. A nice blended framework that's there as well is probably nearer to home, which is in Singapore. The CPF framework also, again, has cohort type of consumption that has an element of protection, has an element of drawdown accessibility, and also has special case drawdown and access in cases of emergency and short-term shocks. So that's a sort of, again, an allowance of flexibility, but yet giving a bit of a protection. There is another framework that I've recently come across, and there's some research around this, which is leading to the target income and the target lifestyle in asset allocation, and that is in Mexico. And I think in Mexico, there are target lifestyle asset allocation products for the combined accumulation and decumulation phase that are coming up. And I think that's a sort of another framework that we can look at. Bill's mentioned some of those occupational pension scheme type approaches in the UK, in the Netherlands, that also are there. However, what we have to remember in India is that what we are talking about is a citizen-wide ship kind of access ecosystem, whereas some of the countries in Europe, are, and in the US, let's not forget that 80 to 90% of their workforce is in the formal sector. We have the reverse. And so we need to just make sure that whatever we look at, we're also making it contextualized for the informal and formal workforce perspective. So I'll just end, Sumiji, on just to say that greater flexibility comes with greater accountability and responsibility for the subscriber. And therefore, I think I will only say that the work that us as an industry and an ecosystem will have to play in the continued education and ensuring that mis-selling, misrepresentation, and misinterpretation is not done is going to be a big, big challenge. And the last innovation, which I think will lead on very nicely to Mr. Arunji, is turning the whole problem upside down. And that is to say, rather than decumulating in retirement, why don't you secure the income while you're actually accumulating itself? And I think he'll talk a lot more about that, so I won't go into much detail about that. But to say that, turn the problem on its head, secure the income stream at the time of investment, and hopefully that can help a long way to controlling the sustainability and the long-term viability and financial security for members in old age. Thank you.
Thank you. Thank you so much, Mr. Patel. You dealt in detail with 3 of the countries, the practices that they have, and also the point that one size cannot fit all in India. We have so much of diversity. And of course, you introduced Professor Muralidharan, who's our next panelist. Last but certainly not the least, sir has been engaged in the floating the Rend A+ bonds in Brazil, which is quite an innovation. And we would request him to speak about that. So the question to him is, how do India's inflation-linked deferred income annuity-linked securities and Rend A+ differ from the traditional Indian government and inflation-linked bonds? And how might they improve retirement outcomes compared to the current annuity and bond ladder solutions? What risks do they help retirees manage, such as longevity and standard of living maintenance? And what can India learn from the operational experience of Brazil in implementing similar products for a diverse retiree population? So over to you, please.
Thank you, Sumit-ji. And, it's very auspicious that this seminar is being scheduled on Dussehra and Gandhi Jayanti as well, right? So you've got 2 brilliant sort of bookends to a seminar, because I think making sure that people get a secure retirement, to Kulin's comments, in a population as diverse as India, is the fight of good over evil, right? The evil being that people retire poor. The fundamental challenge, and everything I've taken from the comments so far, especially Arora ji and Srimati Jaisima as well, is a conversation that you can't have with your average Uber driver or chaiwal, right? If you want to have a robust solution for India, you have to give them something where they don't even know what a GSEC is or what a 10% yield is. But what they do know, and this was based on work that I did in Brazil, I used to manage the World Bank's pension fund, but my own defined contribution is a complete disaster, right? And so the idea is that if when you go to a situation, if you could go to the next slide, Sumiji, to the letter of invitation that you kindly sent me, you laid out very clear objectives. That is, we want to have inclusivity, we want to have innovation, we want to be digital. Increasingly, people are getting disconnected from their jobs because they have gig work and it's not full-time employment. So I personally think that in designing the system for India, don't follow the UK, don't follow the Netherlands, don't follow Australia, right? I've worked in all those countries. Those are not models that are worth emulating. And interestingly enough, if you're trying to achieve all these objectives, I think what Brazil did is worth emphasizing because they looked at the challenges that you face in a diverse population of people who have informal work. They have a lot of digital access. They have a system very similar to UPI that you have in India. And so we created an instrument along with the Nobel laureate Bob Merton that I think could be a model for India, which is very similar in principle to what your pension credit idea is, right? So if we can just skip 2 slides down, as we noted, and Kulan actually brought this point right up front, but I think you brought it out in your introductory comments. People don't care about a rate of return, but planning for investments, planning for retirement is a very complicated activity. It's about accumulation, decumulation, compounding, and inflation, which is beyond the financial literacy of, I would say, 90% of the people even in this room, let alone the population of India. And so my idea was that India should copy what Brazil has done and issue a security that I call India's, which is inflation-linked, deferred income, annuity-like securities, for exactly the reasons Mr. Arora mentioned, which is once you have annuities, they're opaque, they're inflexible, there's a lot of pin risk on when you buy it, they're illiquid, and so they just basically aren't purchased. And my advisor, the Nobel laureate Franco Modigliani, coined the phrase annuity puzzle because despite its attractive features, very few people want to buy it, myself included, and I'm a pension expert, ostensibly having done this for 35 years, right? So the idea behind the security, if we can go to the next slide, is to make the whole problem extremely simple, which is, let's say either the government, state or national, or even a private company, but ideally let's start with, let's say the Indian government for now, issues a bond that pays you nothing till you get your retirement date, let's say that's 60 or 62 or 65, doesn't matter. And then it pays you 5 rupees real per month for 24 months, which is the average life expectancy of the country, right? It'll normally cover the life expectancy of poor people. And why did I pick 5 rupees real per year? I used to issue bonds for the World Bank, so I know how complicated a bond can be. The idea is that if a rickshaw driver says, I want 5,000 rupees in today's income to survive in retirement, then the goal is you have to make sure they buy 1,000 bonds, or as you called it, 1,000 pension credits. This bond could have been issued. The idea was that it would be liquid, it would be easily traded, and inheritable, which then solves a lot of the problems about joint life and the complexity of having to model all of that, right? Now, good news for India is that the model was launched in Brazil. The next slide, please. Brazil launched this in January of 2023. It's been incredibly successful. It's completely voluntary. You can purchase this off an app on your phone, which asks exactly the questions that you had in your initial slides for pension credit idea. 354,000 people have bought it, including 190,000 people who had never bought a security before from the government. That is financial inclusion in my mind. You can actually even get it on gift cards. When I mentioned this to friends in India, they really like this idea for giving a Dashera Bakshi in the form of a gift card that would lock up somebody with guaranteed retirement income, as opposed to giving them cash, which sadly their family members would go and drink or gamble away, right? And they've also been able to do some interesting things on gender equity that I'll talk about in a second. But if you go to the next slide, this is how simple they made it, which I think lends itself to India, which is they have a simple app on a phone or a website. It asks you some basic questions about, like you said, weight of retirement, what's your age, and what's your target income. And you press a button, and on the next slide, it tells you what security you should buy. And it tells you the progress you're making towards your retirement goal, right? And so that's essentially where, India can easily take this on and build the security. And because it's inflation linked, you can protect against standard of living. Now, to Sumitji's question about why have inflation-linked securities in India failed, I think the analogy is a poor one only because it's like trying to sell a car where you put the steering wheel in the back seat, right? Traditional inflation-linked securities do not meet the goal of any investor, so obviously they should fail. In fact, it's a good sign that they fail, which means that investors are intelligent. What Brazil has shown is that if you design a security with the linkage to inflation that actually caters to the goals-based investing needs of individuals, whether it's retirement or education, people will buy this voluntarily. You don't need to force auto-enrollment and mandation as well, right? So essentially the argument I would make, now what is the risk of this instrument? You obviously need an issuer like a government if you're hoping to do this for a 20-year term for a 25-year-old. But there's no reason why a private insurer can't issue these bonds for 55 or 65-year-olds. But then also to your point, they don't need to cover the entire 20 years. They could break it up into 5-year segments of guaranteed income, and that could be rolled over on a periodic basis, right? So the reason the government is the best issuer for this instrument, and let's say in India, they indexed it to a GST index, then in effect, the government is hedged because its revenues are in GST and its payments are in GST. And you're now giving people indexation not just to inflation, but also to standard of living, which is increasing very dramatically in India. So I think India can leapfrog all these other countries and design something that's unique to itself. But obviously that would require coordination from the Ministry of Finance and the RBI and maybe the stock exchange, because in Brazil, this is listed on the stock exchange. Prices are quoted 3 times a day, and you can buy and sell. So you do have a secondary market, which is completely liquid, and there have been examples of people actually doing it. So I think my final comment would be to the point of your slide, which says Zaruri Hai. I think India's is a Zaruri Hai for India right now. I think to go back and try to do the clunky annuity type of products or failed models from other countries would actually be a missed opportunity, given that you're trying to do something here. Thank you.
Thank you so much, sir, for giving a detailed explanation on the Rent A Plus bond, which are quite innovative instruments and have also helped to develop the market there for the pension product. So we come to the end of the panel discussion, and we are very thankful to Arora sir for coming here physically and enriching us with his rich experience, and of course to all the 4 panelists who have joined us online. 3 of them are from abroad, and they have timelines. I think this must be an ungodly hour for them to join the panel discussion, but we are very thankful for them for giving us a detailed enriching our session with a variety of thoughts ranging from annuities, the innovation in annuities, what are the products that we can look into, what is there in the international market that is happening, and the SWPs, and also the new kind of products that are being uptaken, like in Brazil, the Rent A Plus or the selfies. So I think all of these we will look at closely in PFRD. As you're aware, we're already looking at the decumulation phase products, and we've given a presentation on that. And we are also looking forward to the experts' opinion on the paper that we have put out till 31st October, and we really look forward to it. Do we have time for the Q&A session, or are we running out?
Ma'am, we'll wind up with the takeaways.
Okay, so I think in the interest of time, because we have a plenary session with an important guest, we need to stick to the timelines. I'm sorry we're not doing the Q&A, but you're welcome to ask your questions on the sideline of the conference. So again, in the end, I thank the panelists, and over to you, Kavita.
Thank you, ma'am. Yeah. As rightly mentioned by the esteemed panelists, the key takeaways of this panel discussion and way forward is to focus on diversifying annuity options, assessing the longevity risks, and encouraging collaboration among stakeholders to ensure dignified and reliable post-retirement financial security. रिटायरमेंट के बाद भी जीवन में वित्तीय सुरक्षा के लिए एनपीएस जरूरी है. Let's give a huge round of applause for all the lovely panelists here. Thank you all for joining and making this fruitful discussion. I now request Sumit ma'am to present the planters as a token of appreciation to our esteemed panelists. Yeah. Starting with Randeep Singh Jagpal sir. Shri P.K. Arora, sir. Perry, sir. I request Ruby Vinayak Bhausagar, AGM PFRDA, to come on the dais to present the token of appreciation to Sumit ma'am. For the panelists who have joined virtually, yes, okay, yeah. Yeah, thank you. For the panelists who have joined virtually, though we can't present mementos in person today, our gratitude for your valuable insights and contributions is heartfelt and truly treasured. Thank you for enriching this event with your wisdom from afar. Thank you all. This concludes our first technical session. Our next technical session will focus on securing old age income security for agripreneurs, Laghu Udhyami, and platform workers. We will resume shortly. Please stay tuned. Thank you.
I am Ruby Vinayak Bhavsagar, Assistant General Manager PFRDA, and it is my honor to welcome you all to the second technical session of today's conference on NPS Diwas. The national pension system has become the cornerstone of retirement security for millions, proving that disciplined savings can indeed forge a financially independent future. While NPS has flourished in the formal sector, today we turn our focus to the very foundation of India's economic engine, the vast unorganized sector. We are here to deliberate on the most priority of our time, securing old age income security to agripreneurs, Laghu Udyami, and platform workers. This session is designed to move beyond traditional discussions. We will be exploring innovative, tailor-made solutions from policy flexibilities and digital onboarding to product innovation and financial literacy that can effectively extend the social security umbrella to these vital yet vulnerable segments. To guide this important conversation, we have assembled a panel of distinguished experts, thought leaders, and policymakers who bring a wealth of experience from the financial, agricultural, and technology sectors. They will share their insights on how we can bridge the current pension gap and integrate these deserving populations into the NPS framework. Ladies and gentlemen, please join us in welcoming the esteemed members of our panel. First, the context setter for this discussion, an individual whose expertise at the intersection of economics and policy is invaluable, Ms. Mamta Shankar, whole-time member economics, PFRDA. Ms. Mamta Shankar is from the Indian Economic Service 1993 batch. Before joining the current assignment, she was Senior Economic Advisor, Department of Food and Public Distribution, Ministry of Consumer Affairs. Prior to that, Ms. Shankar has served in senior positions in Ministry of Development of Northeastern Region, Ministry of Agriculture, Niti Aayog, Department of Commerce, and also at Micro, Small and Medium Enterprise Development Center, Imphal. She has done her MPhil from International Trade and Development Center, JNU, and MA in Economics from CESP, JNU. Welcome, ma'am. Next, from the heart of regulatory authority, a key driver of NPS promotion and development efforts, our Executive Director and moderator for this panel, Ms. Mamta Rohit. Ms. Mamta Rohit has an experience of more than 35 years spanning across banking and pension sector. She joined State Bank of India as a probationary officer in 1990. In SBI, she worked in the areas of international banking and small business credit. In 1998, she joined IDBI Bank, and in 2011, she joined Pension Fund Regulatory and Development Authority, where she has led various departments of regulation and supervision of all intermediaries and other support departments. Presently, she is holding the position of Executive Director, and she is also a board member in IFSCA. She graduated from Lady Shri Ram College, is a PGDBA in HR, is a certified associate of Indian Institutes of Banker, is also a certified Train the Trainer, and holds a master's degree in commerce. Thank you for being here, ma'am. From the largest commercial bank in the country, bringing the massive scale of public banking and its reach into rural and SME segments, Mr. G.S. Rana, Deputy Managing Director, State Bank of India. Mr. G.S. Rana is presently holding the position of Deputy Managing Director, Retail, Personal Banking and Real Estate at the State Bank of India. He joined the bank as a probationary officer in 1991, and his journey of 33 years serving various positions in different geographical locations in the bank is exemplary. He has handled important assignments in various capacities in retail banking, credit, human resources, and international banking. He holds a master's degree in chemistry, is a certified associate of Indian Institute of Bankers, is an MBA from SP Jain Institute of Management and Research, Mumbai. It's a pleasure to have you here, sir. We are honored to have representative from the Apex Development Bank for Agriculture and Rural Development, providing the perspective of grassroots financial inclusion, Dr. A.K. Sood, Deputy Managing Director, NABARD. Dr. Ajay Kumar Sood is the Deputy Managing Director of NABARD, an apex government institution dedicated to agriculture and rural development in India. Dr. Sood earned his PhD in agricultural economics and possesses extensive experience in agricultural development and rural banking. Throughout his long tenure at NABARD, where he has served in various capacities, Dr. Sood has made significant contributions to rural and agricultural infrastructure development, strengthening of rural financial institutions, and promotion of grassroots and community groups. Your presence honors us, sir. Thank you. Next, representing the crucial sector of agricultural finance and enterprise, the founder and CEO of Samunnati Group, known for unlocking the trillion-dollar potential of Indian agriculture, Mr. Anil Kumar SG. Mr. Anil Kumar SG is the founder and CEO of Samunnati, India's largest agri-enterprise pioneering an integrated value chain approach to unlock the potential of Indian agriculture. With a sharp focus on smallholder farmers, Samunnati has an outreach to over 30,000 farmer collectives and 3,500 plus agri-enterprises, and has enabled over USD 3.5 billion in gross transactional value since inception. Mr. Anil Kumar brings nearly 3 decades of experience in banking and rural finance, having earlier co-founded IFMR Trust. A recognized thought leader, he serves on the Ministry of Agriculture's expert group for the National Policy on FPOs and chairs the FICCI Task Force on Agri-Finance. We look forward to your insights, sir. Representing the new age gig economy, the sector that NPS aims to reach with unique solutions, the CSO, Chief Sustainability Officer of Eternal Limited, the parent company of Zomato, Ms. Anjali Ravikumar. Ms. Anjali Ravikumar is the CSO at Eternal Limited. She is leading the company on a path to become people positive and planet positive. Her focus is on building programs and partnerships to ensure zero waste, reduce emissions, promote diversity, reduce hunger, promote health and well-being, and create inclusive growth. Eternal comprises multiple platforms including Zomato, Blinkit, District and Hyperpure. Zomato is India's leading online ordering and food delivery company with a history of supporting sustainability initiatives that have positive social and environmental impact. Thank you for being here, ma'am. And finally, to provide the essential insight from the startup and venture capital ecosystem, the founder of iVentures Capital Private Limited, who understands the financial needs of the burgeoning MSME sector, Mr. Nirmal Bansal. Mr. Nirmal Bansal is founder-promoter of iVentures Capital. He is UCLA Anderson alumni with 15 years of prodigious experience in the capital and financial markets. Prior to the inception of iVentures Capital, he benefited Merrill Lynch with his expertise, now called DS BlackRock. Mr. Nirmal Bansal has an exceptional competency in trading, options, algorithms, forex, and stocks. Mr. Nirmal is an active member of various industrial associations, which include ANMI, CPAI, FICO, IMSME of India, and many more. iVentures Capital stands as one of the fastest growing financial broking and advisory boutique firm. A warm welcome to you, sir. Thank you to all the panelists for being here. Now I request WTM Economics ma'am to kindly set the context for this discussion.
Chairperson PFRDA, full-time members, my esteemed panelists, distinguished invitees and guests, colleagues and friends, a very happy NPS Diwas to all of you. The first session was intellectually stimulating. However, it also pointed out for a need to have a pension solution for our very inclusive, dynamic, and diverse population. So not only the diverse population, but we also have a very diverse workforce. In this session, we are going to focus on these important segments. So we have agripreneurs who are transforming traditional farming into enterprises of scale and innovation. We have Laghu Udyamis, our small entrepreneurs and MSMEs who form the backbone of our economy, generating employment and livelihoods. And we have platform workers at the frontier of the digital economy, powering the services that millions of us have come to rely upon every day. Their contribution to nation building are immense, but one challenge binds them together: the lack of assured financial security in old age. Pension is not just about savings, it is about dignity, independence, and resilience in later years. So we are committed to addressing this need of our informal workers, our agripreneurs, Laghu Udyamis, to start with. The scale of opportunity before us is extraordinary. India has over 45,000 farmer-producer organizations, linking more than 90 to 100 lakh farmers. Maharashtra alone has 15,000 FPOs, while Uttar Pradesh and Madhya Pradesh together add nearly 9,000 more. Each FPO with 300 to 1,000 farmers is a natural collective base engaged in productive and income-generating activity, to extend social security measures like the NPS. In the MSME space, 6.85 crore enterprises employ nearly 29 crore people. Yet, pension coverage here is still nascent. PFRDA has identified 12 high-density MSME states, including Maharashtra, Gujarat, and Tamil Nadu, with an ambitious goal of 25 lakh new subscribers in 25-26 alone, adopting a cluster-based approach across sectors like pharmaceuticals, textiles, engineering, and food processing. And in the platform economy, the potential is equally transformative, counting 7.7 million gig and platform workers in 2021, who are projected to grow to 61 million by 2047. To include them, PFRDA has rolled out the NPS platform workers model to be inaugurated later in the day. Here, the aggregators like Ola, Uber, Zomato, and Swiggy can facilitate enrollments through their digital platforms, making participation simple, seamless, and flexible for those with variable incomes. Needless to say, our intermediaries have responded to the challenge and come to address the pension requirements of these segments. The national pension system has proven itself to be a robust, inclusive instrument. Our task is to innovate, collaborate, and design pathways that make pensions not only accessible, but also attractive for these crucial segments of the society. PFRDA is committed to providing something for everyone for their old age security. And later in the day, we are going to launch new pension schemes by the pension funds. We are also going to share with you the results of innovative, creative content creation. And we have also tried to initiate our pension agent onboarding of platform workers and MSME clusters, all on this auspicious day of NPS Diwas and a very good day of Navami, of the Navaratri season. And with this, I request my esteemed panel and my moderator to take over the session and enlighten us in our journey onward. Thank you.
Thank you, ma'am. Thank you so much. And good afternoon, everybody. And wish you all a very happy NPS Diwas. Before beginning, I just want to request the panelists that we are running short of time. So maybe just 5 to 6 minutes for each one of you, and maybe no time for me. So with that, we start. My first question will be to Mr. G.S. Rana. As borne out by ma'am, you know, the data shows that the canvas is huge and the scope is very large. And, you know, that matches with the network of branches that SBI has. And the digital network also, SBI is very evolved there too, you know, through YONO, etc. So, sir, how do you think that SBI can leverage its network as well as, you know, the branch as well as the digital to expand pension coverage, you know, amongst the agripreneurs and the entrepreneurs?
Thank you, ma'am. Very good afternoon to all of you. I think the apt topic, you know, given to the bankers like us. In fact, just to set the context, I would just, you know, throw the numbers before all of you. We have a customer base of 53 crores. So I think practically every third Indian banks with us. And if I talk of family, probably we are touching each and every family we have in India. I think when the last 10, 12 years, when the government of India came out with the social security schemes like starting with, of course, the Jan Dhan accounts, then Pradhan Mantri Jeevan Jyoti Bima Yojana, Suraksha Bima Yojana, Atal Pension Yojana. If I give you the number, they're really interesting numbers. We have 56 crore Jan Dhan accounts in the bank, and out of 56 crore, around 17 crores are with State Bank of India. And at the industry level, we have Pradhan Mantri Jeevan Jyoti Bima Yojana registration of 33 crores, Suraksha Bima Yojana of 51 crores, and Atal Pension Yojana of 8 crore. And everywhere, State Bank has a market share of around 30-35%. In fact, schemes like JJBY, Jeevan Bima Yojana, our market is 40% plus. But when you look at the NPS numbers, I think, madam, is 1.65 crore, is it correct? So this is the number of 1.65 crore NPS subscribers as on date. So if I look at the, you know, gap we have, probably we have 1.65 crore subscribers as on date NPS subscribers.
And even I look at our internal data, only looking at the agripreneurs, that is agri-entrepreneurs and the Laghu Udyami or the SME enterprises. So we have 43 lakh agri borrowers, including farmers, producers organizations, those are into investment grade and also. We have 43 lakh agri borrowers and around 28 lakh SME units. So if on conservative basis, if I say that every SME units or the Laghu Udyami unit, they have on an average 5 to 6 employees. So that means that is readily available customer base, NPS potential data for us to the tune of 1.5 crores. And I'm sure the way probably we sell in the bank our own products, maybe deposit for loan products, and off late also our subsidiary, that is SBI Life Insurance, SBI General Insurance, our own AMC's product, the kind of focus probably, if I talk of NPS, that's still not there. That scale is not there. And I think all of you agree with me, jo dikhta hai, wo bikta hai. Look at the SIP inflows today into the market. 28,000 crore of, SIP investment is happening every month in the market. And that investment is, increasing probably every month by 500 crore, 1,000 crores. And even when the markets are down, when the FII probably they exit the market, our market continue to be that resilient level only because of the retail investor to some extent. So, and the number of SIP investors as on date is around, I think, 5.4 crores. So that we can see that the average SIP ticket is around 5,000 rupees per 5,000 rupees. So every month an individual investing 5,000 rupees by of SIP in the market, I am sure we have, huge market when it comes to tapping the NPS also. And if I talk of the Laghu Udyami or the SME customers, we have 900 plus SME intensive branches. So practically every district we have one SME intensive branch. And these SME intensive branches are headed by a person who is, who has good credit experience, and he is supported by something called relationship manager SME for the SME customer. So we have 2,000 plus RMSMEs, relationship manager, who are supporting the SME customers. So probably if we take the help of these relationship managers, 2,000 plus, and 900 plus SME intensive branches, we can definitely pitch for the NPS among the SME units and their employees. So there's a huge scope. And if I talk of, I say 43 lakh farmers, so there we have also the main portfolio, SME agri portfolio, which also constitutes about the self-help group, about the farmers producer organization, investment credit. So there also we can pitch for the NPS product. And if I talk of the overall branch network State Bank of India has, we have 23,000 plus branches. And out of this 23,000 branches, 50,000 plus branches, that is almost 65, 2/3 of the branches are in rural and semi-area. So where all these customers will be there. So the network we have probably in the form of rural branches, semi-urban branches, and the number of customers, SME units we have, I am sure this topic is apt for us, and we can definitely pitch for these NPS, and we can, the gap I see vis-a-vis the social security schemes and the SIP or the insurance, and probably the target which government of India has taken, like SME, like insurance for all by 2047. So likewise, I think we can also think of NPS for all by 2047. Thank you so much.
Thank you so much, sir. The numbers at State Bank as well as your assurance, both are extremely reassuring for us. And we also, we undertake that we'll do all that we can to have, fruitful partnerships with State Bank at all levels. Now my second question is to Dr. A.K. Sood. NABARD has been pivotal in supporting rural entrepreneurs and FPOs. How can NABARD integrate pension awareness and adoption into its ongoing farmer and agri-credit programs? Sir.
So good afternoon to everyone here. Since the topic is on agripreneurs, MSME and platform workers, so I think these are the categories where the vulnerability is the highest, the income uncertainties are the highest. So, and they require the social, some kind of social security for them. So we have been conducting NABARD financial inclusion surveys for the last 2 sessions. I mean, it is conducted once in 5 years. So second of the series we have conducted. So as per that survey, only in case of 24% of the households, at least one member was covered under life insurance, which means the 75% of them or 76% of them still they do not have access to these services. And also that there is a critical linkage between the livelihood security and the livelihood security and the financial inclusion. And social securities must be these livelihoods. These are some of the major broad findings of this survey. So apart from this social security, we are also, as a developmental financial institution, we are also looking into the ecological security part of the farmers, because that is now in the changing climate scenario, that is so important. So we have been running various interventions for the farmers, for the MSMEs, for the platform workers, like our watershed programs, our support for the tribal farmers, our organic and natural farming initiatives. So through them, we have been taking such ecologicals so that the income vulnerabilities are reduced. In terms of adoption and taking these initiatives to the field, I think the one aspect is that the requirements are very heterogeneous in terms of the states, in terms of the social groups. So there we need to, sit with these people, sit with these organizations. One thing is very important, that we are working with FPOs and cooperatives. If you see the network of the cooperative itself, it is 8 lakh cooperatives that we are working with. And in terms of the FPCs, registered FPCs are around 45,000. So there is a huge network which is available to carry forward these interventions to the field. So the projects that we have been doing in the field, we have done certain studies to understand that how this pension penetration is there. So we find that 77% of the households, they lack any kind of pension penetration, any kind of pension coverage. So therefore, there is a need for targeted and localized approach. And we can work with the cooperatives, vast network of cooperatives. We can help design the products according to the genuine requirement of the people. So we can help PFRDA to reach to these beneficiaries through these grassroots organizations, what we call as the social capital. And then there is one more platform, which is the banks, like State Bank of India and all banks. They have been doing financial literacy campaigns. And we have been supporting these campaigns through our Financial Inclusion Fund. So there are large number of campaigns that are being run. So through these platform also, these schemes can be taken. It is not that this is not happening, this is happening, but probably there is a need for a mission mode approach to take it down to the people. SHGs and FPOs, they can be used as social security mitras, like SHG mitras or bank mitras. The only need is that we need to design incentive structure for these organizations, that they should find some value for working for this. So I think we can work with PFRDA to take these initiatives to the field. Thank you.
Thank you so much, sir. That gives us good insight, into as to how we can reach out to this sector that we are aspiring for. My next question is to Mr. Nirmal Bansal.
Yes, ma'am.
Hello. He is representing MSME. So what kind of policy or institutional support would MSMEs need to encourage, voluntary pension participation across the center?
Yeah. So see, ma'am, NPS is a great product for nation building, but we have seen in the past how AMFI has done, mass level marketing, branding strategy across India through, and as Mr. Rana mentioned, how SIP, 5 crore, 28,000 crore of monthly SIP. 10 years back, it was not even 2,500 crores. How this has changed in the last 10 years, because there was a strong campaign. So I think PFRDA, NPS can play a fantastic role in association with a lot of MSME associations across India. If we can create a budget for strong marketing branding, so that, and keep the product simple, because eventually this NPS is going to be at a grassroots level to workers, floor level. Or second thinking that I feel is, what if, especially for women empowerment, if government can contribute the same amount for a lower income age worker, which will enhance the participation. Because see, in India, if you see in the last 20 years, how EPF, or PPF or predictability of returns in other insurance product has garnered huge sum of corpus. What Indians love in the last 20 years, I've realized three things. They love predictability of returns, liquidity, and safety of the money. So NPS as is market linked product, because as in the last session I've heard that there is an interest rate scenario which is on the falling interest rate regime. Market is unpredictable. Most of the people want predictability of returns. So what if the NPS can create some structuring in the product which can create the predictability to the masses, because mass level workers don't understand these complex products. So we have to create a workshop at ground level to really enhance and make it work, to across India so that everyone can benefit out of it. So all this, what I have seen, EPF, PPF, all is exempt. So I have seen 60% of the corpus in NPS is tax-free, but 40% annuity is taxable. So why not government should consider that all annuity must be tax-free? So, all this creates simplicity and probability that everyone will participate, because, I've been managing a lot of SME entrepreneurs for the last 15, 20 years. No one come and ask me that, everyone talks about SIP, as Mr. Rana said, but why no one ask about NPS? So I think, the knowledge transfer, the workshop has not been created to a mass level, or entrepreneurs are not being motivated enough. Because see, this is a fantastic product for an employer to give a lifetime pension for their workers. And if they, get incentive and subsidized for these things, this will create a, motivational environment for employees, because sense of security and guidance of money gives probability of creating wealth for their family, next generation. So I think government should consider these 2-3 ideas. And very important aspect which, most of we face, that in the case of demise of the main contributor of the NPS, the transfer of the wealth, to the nominee, there is a lot of civil disputes and problems amongst family members. So why not, they are the true beneficiary rather than the distributor of according to the Succession Act. So I think these things are not being considered. The nominee should be the true beneficiary of the pension that his husband or the family member has created in his lifetime. So these are very important elements that most of the money, we have seen a lot of money, a lot of wealth is unclaimed in India today. What is the reason? Because will is not being made compulsory by government. Like other car insurance is compulsory, but will creation is not compulsory. So I'll urge, there should be a CAS type statement where all financial securities and a CAS or NSDL or CDSL statement you get all your portfolios in a one single platform which one can see it. But NPS is not there in that statement. So as it is a market linked product, it should also be, one single statement, the entrepreneur should know it. Yeah, that's it.
Thank you so much, Mr. Bansal. Message well taken. I would just like to make one small correction.
Yeah.
You spoke about NPS not being a part of CAS. In fact, our CRAs which send out CAS are also, their officials are also here.
Oh,
so they happen to be NSDL and, the same entities.
Okay.
Now they have an option, but you have to give consent to it. So when you receive the CAS, there is an option and they ask for your consent, but only after
So it's not automated, I have to look at the
yeah,
consent.
yeah,
Okay,
yeah.
okay. Thank
So it's consent based. So my next question is to Madam Anjali. She is from Zomato and she represents the gig worker cohort. So ma'am, platform workers are at the heart of the gig economy, yet most lack social security. How do you see companies like yours, partnering with a regulator to provide them social security?
Thank you so much for having Zomato on this prestigious panel. Just to help you understand, Zomato is the food delivery business of Eternal, which includes 4 businesses, including Blinkit, which is quick commerce, District, which is events and ticketing, and Hyperpure, which is restaurant supplies. Zomato, the food delivery business, is proud to connect 22 million customers every month to 3 lakh plus restaurant partners, which are mostly SMEs and MSMEs, and through a network of 5 lakh delivery partners in about 800 cities. We are particularly grateful today to be here to talk about delivery partners and their social security, which is a very core component of their well-being, which is really at the heart of our business model. And what we're most excited about is that this forum is providing us an opportunity to create an instrument with PFRDA and HDFC that suits their needs, something that is portable, voluntary, and flexible. Because we are seeing an increasing trend towards a need towards flexible participation in work. Just to give you context, last year, that's 2024, partners logged in for an average of 46 days. And most of our partners will work less than 6 hours a day, right? So there is a need for flexible part-time products suited to the nature of their earnings. On the topic particularly of social security, which is not just important for gig workers, but if we can together solve for platform workers, we would have solved for many millions of Indians. It's important to note that platform workers do enjoy the benefit of the central government social security code, which has been in place since 2020. But even before this, since 2018, Zomato has been voluntarily covering all delivery partners with accident and health insurance. And more recently, we even began maternity benefit for active female delivery partners. And all of this is free of cost to delivery partners. Additionally, in the last 18 months, we've been developing a financial roadmap for their security, precisely to address this issue of what will they do in times of distress, what is that corpus they will turn to. And in working towards that vision, we've actually trained 30,000 delivery partners in financial literacy and awareness in partnership with the National Stock Exchange. We have also, since then, opened a facility for them to invest in fixed deposits and recurring deposits seamlessly through the delivery partner application. And this is already on course to generating a corpus of at least 5 crores in the next 6 months. And so all of this has been, again, enabled through tech. So we're most excited to work closely with the NPS, PFRDA, HDFC, to not just design this product, but also to offer it seamlessly. In fact, in the last 72 hours, we have generated 30,000 PRAN numbers for our delivery partner base. And we could not be more excited for this offering because, as I just described, it's truly the need of the hour to match the earnings and requirements of this crucial segment of India's workforce.
Excellent. That was really impressive and very sensitive, you know, and I think we should give them a round of applause for generating 30 PRANs in last 72 hours. Just to give you a small idea of what PFRDA has been you know, doing in this direction. Yesterday only, our chairperson was in Panchem, and we have on real time enrolled the PRANs of these drivers, you know, cab drivers. So he was there to inaugurate one such platform event, and in which we are, you know, encouraging these kind of integrations. So we will work forward not only with you, I think with other platform workers as well. And now my next question is to Mr. Anil Kumar. Samunati has built strong linkages with FPOs and agri enterprises. how do you see pensions being integrated into these networks so that smallholder farmers and agripreneurs both can be benefited through social security, sir?
Thank you, ma'am. Good afternoon, everyone. It's wonderful to be here. And I would also like to thank PFRDA for being part of the FPO conclave that we had on 3rd and 4th of September, jointly hosted by NABARD and Samunnati, where they saw the network of the FPOs and their ability to reach out to the smallholder farmers. Samunnati, the word stands for collective growth, collective prosperity, and collective elevation. And we are an agri-value chain enabler, engaging with the smallholder farmers in order to make markets work for them. Making markets work for smallholder farmers. The word "for" is an important dimension for us. So whenever you engage with a smallholder farmer, you always have this dimension of actor versus activity. The activity being agriculture and the actor being the farmer. And having spent a little close to 3 decades, the line between the actor and activity is so blurred that you cannot not engage with the household comprehensively. It is this comprehensive engagement as an agri-value chain enabler that led us to look at how do we understand the risk and manage the risk of a smallholder farmer while looking at engaging with them as a value chain enabler, where we provide access to finance, market linkages, and advisory services, mostly on the activity called agriculture. It is in that context that we understood the risk management philosophy has to be manage all the risks of the household comprehensively. And it is in that context that we designed an umbrella engagement that we internally refer to as Annadata Suraksha Abhiyan. That's an internal umbrella scope of engagement that we have to manage the risks, where we looked at how do you look at the family from the dimension of all the risks that the family is exposed to. One is insurance, both life and non-life, and then the old age protection. Because most of the development economics that at least I have been exposed to talk about how the households aspire their children to go to the government jobs because that's where the pension is. So they start with the end in the mind, where the children will have to have a safe post-retirement life. And from their part, significant portion of investment in education of the children by the low-income households happen because that's part of their pension policy. So what we started understanding is, can we take the pensions as part of the Annadata Suraksha Abhiyan in protecting the farmer and the household from the pension dimension? And when we talk to them saying, what if you have pension for your old age? It starts with one, a disbelief. Second, an excitement that it is possible in their own lifetime. And most importantly, is it coming from a trusted source like the sovereign of this country? It is coming from the government of India. So we were quite enthused when we looked at the interest of this particular product from our farmers. And we said, how do we reach out to them? Because you have to reach out to them, as Dr. Sood mentioned, through social capital. It's important that trust needs to be banked upon while taking products like this to the farmers. And this is where we see the role of the FPOs, where the FPOs are owned, managed, and operated by the farmers. Farmer producer organizations is what FPOs are. And you cannot have a better vehicle to take a product like this to their members as a network. And this is where Samunnati can play a significant role. Of the 45,000 FPOs that both Mamta ma'am and Dr. Sood mentioned, Samunnati has access to about 30,000 FPOs. And we would like to partner with PFRDA in doing 3 things. One, take this product and the awareness of this product through the awareness programs of this network of 30,000 FPOs and enable them to offer it to their members. 2, facilitate the registration of the members and provide the know-how in terms of how this product can be offered to them. And last but not the least, provide a continued hand-holding so that pension becomes a reality for the smallholder farmers. That's what we are hoping to do through the network of FPOs. What we also realize is FPOs at some point in time would need spokes, which are agripreneurs, and we call them as village-level entrepreneurs. And each of these village-level entrepreneurs can have a reach to about 200 to 300 smallholder farmer households. Can we now take from the FPO to the VLEs and from VLEs to the farmers so that in every revenue village, so to say, we have a representative talking about the safety of the farmer household, from insurance to pension to managing their liquidity for their old age. But the only question, the last point I would like to make is, the only question is, how do you define the retirement age for the farmer? That is a question, because we all know a farmer seldom retires. But then we have to bring in a dimension of rest for the farmer. Can we also say that आपने बहुत काम कर लिया, अभी अब आराम का मामला है, you don't need to be still struggling to have your basic needs met. And here is a proposition, none other than Government of India bringing you through PFRDA a safety net at your old age, and that's what we aspire to do. Thank you.
Thank you so much, sir. Samunati seems to be taking a lot of proactive steps, not only in providing social security, but in spreading pension awareness also, you know, in ensuring that pension awareness does reach this segment. Now, sir, all of us, I mean, most of the panelists who are sitting over here, they are dealing with the vulnerable section of the society who have little or no means. At the same time, we are discussing about their, you know, their contribution. It's a defined contribution, it's not defined benefit. So, I think you have already spoken about pension awareness, but I would like to hear from the other panelists, where do you think or how do you think can you reach the target segment? What all we can do to increase the pension awareness or pension literacy? So, beginning with Mr. Bansal.
Yeah, I've already mentioned, I think we need financial literacy, although not taught in the school, now started teaching the school so people will learn. You know, we all learn compounding, but the true meaning of compounding, how it becomes 9x, 10x, you know, we don't calculate in the multiplication form. So if we teach, you know, and create a mass level workshop at a floor level, you know, to empower what true meaning of how to build up their personal net worth, you know, this will create a sense of security, and money solves most of the problems. So I think in the association, and there are a lot of fintech companies today, as ma'am has mentioned in Zomato, how they are making a difference to the community. So same thing can happen into different fintech platforms where one can easily onboard, you know, easy to navigate, you know, ease of access, tracking it easy. So I think this will give a lot of confidence, trust building amongst the workers, and entrepreneurs, small entrepreneurs can play a fantastic role with an association of small clusters and association. And it's a continuous exercise, I think. That builds trust over a period of 3 years, 5 years, 10 years. That will create a ripple effect in the system.
Thank you, Mr. Bansal. Can we have a line or two from Mr. Rana too?
In fact, when we talk of the visibility for the product for NPS, of course you ran a campaign sometime in the past about the NPS Zaruri Hai. And I think all of us have seen the insurance campaign about Acha Kiya Bima Liya during the IPL. So by probably that kind of visibility, and especially the target audience we have in the form of agri entrepreneurs or the small enterprises, the probably small videos in the local languages that will help, you know, reaching to the target audience. That's number one. Number two, we have a rural self-employment training institute, you know, in the entire country, 600 plus. So there the rural youth, they are trained so that they get self-employed. So probably there also we can have some sort of NPS for those, you know, those trainees are taught about what NPS is and how probably when they gain some self-employment, how they start their own NPS and so that they have some social security. And the third piece is about every district we have district industry center. In fact, every government-sponsored scheme, loan scheme, normally it is sponsored, not it is originated from the district industry center. So any young unemployment youth who wants to start his own enterprise, he gets introduced first from the district industry center. So probably connect with the district industry central will also help so that the loan applicant who is going to start his own enterprise, small enterprise, he also gets to know what is NPS. So these
Thank
two,
you.
3 points would help, I think.
Thank you, sir. Voluntary contributions are again a very, very big challenge. Defined contribution is impasse in sector. So a line or two, sir.
So why the penetration is low? Because lack of awareness, then perceived unaffordability and lack of outreach. So I think we need to use the local leaders as the pension ambassadors. Recently, we have done computerization of about 70,000 primary agricultural credit societies out of the 1 lakh. So I think this network can be very effectively used as pension ambassador to take these initiatives to them. The only need is that we need to define the incentive structure for them. Thank you.
Thank you so much, sir. Ms. Anjali.
We have deployed both physical and digital outreach mechanisms to enroll thousands of delivery partners into various government schemes. And what we found is you have to meet the delivery partner where they are, that physically, more in their areas of work, as well as we need to offer scheme delivery online that is entirely digitally or digital first, because that reduces the friction and makes the entire enrollment process seamless.
Thank you so much, Anjali. I think, so we are all on the same page. A lot of digitalization, a lot of integrations, a lot of partnerships, a lot of reaching out through, various forums and going down to the last mile connectivity. I think that's the way forward. And I think we are going to do all of it. From the phase 2 of our today's program, you will get a fair idea as to how we are all, moving towards that direction. And we'll look forward to your individual inputs any which ways later on as well. So thank you so much.
Thank you to the entire panel for the truly stimulating and impactful session. We saw a powerful convergence of ideas, reinforcing that retirement security for the unorganized sector is not just a social goal, but an economic imperative. The key takeaway is the urgent need for PFRDA, banks, developmental institutions, and tech platforms to collaborate and jointly work on increasing awareness at the grassroots level, incentivize the stakeholders, and leverage digital infrastructure to co-create a retirement security architecture for the agripreneur, the Laghu Udyamis, and the platform workers. We are deeply grateful for the intellectual capital shared on this stage. And before we conclude this session, we would like to extend our sincere thanks to all the panelists by presenting a planter. Therefore, I now request Ms. Mamta Rohit, Executive Director, to kindly do the honors of presenting the planters to our esteemed panelists. Ma'am, please. We begin with the individual who represented PFRDA's relentless drive, Ms. Mamta Shankar, whole-time member economics, PFRDA. For the crucial role of large-scale finance in this ecosystem, we thank Mr. G.S. Rana, DMD SBI. We then honor the development banking perspective provided by Dr. A.K. Sood, DMD NABARD. Next, for bringing us the vital voice of the agripreneur, Mr. Anil Kumar SG from Samunnati. And for championing the perspective of the platform workers, Ms. Anjali Ravikumar, CSO, Eternal. For his essential insights into the startup ecosystem, we thank Mr. Nirmal Bansal from iVentures Capital. Finally, I request Ms. Jaspreet Kaur, General Manager, to kindly come on stage and present a token of appreciation to the person who expertly guided and moderated our entire discussion, Ms. Mamta Rohit, Executive Director, PFRDA. The way forward is clear: partnership, policy, and persistence. By combining the financial innovation and reach of our partners with the progressive regulatory environment of PFRDA, we will transform retirement security from a privilege of few to a right for every citizen. This concludes our second technical session, and we will commence our third technical session right away. Thank you, and see you soon.
Good evening, ladies and gentlemen. It is my great honor and privilege to extend a warm welcome to all of you at this esteemed event. I, Jaspreet Kaur, am delighted to greet our distinguished speakers, respected dignitaries, and valued participants as we begin another session of the conference. Your presence today adds immense significance to the discussions ahead. As you may be aware, that PFRDA has recently introduced the multiple scheme framework, which will formally be launched by Honorable Union Minister of Finance in the upcoming plenary session. This momentous launch signifies a transition from a uniform single model pension system to a diversified, choice-driven structure that empowers subscribers with enhanced flexibility, transparency, and return potential, while also ensuring safeguards through default options. Panel discussions play a vital role in bringing together diverse perspectives, fostering meaningful dialogue, and offering valuable insights on complex topics. In this spirit, our upcoming panel discussion will focus on the launch of pension fund schemes under the multiple scheme framework and the range of choices available. Before we dive into the discussion, let me introduce our esteemed panelists who bring a wealth of knowledge and expertise to this conversation with a request to kindly join us on the dais. First is Mr. Sanjay Pandey. Sir, please, you are requested to be on the dais. Mr. Sanjay Pandey currently serves as the whole-time member finance at PFRDA. Sir was Additional Secretary to the Government of India and Financial Advisor at EPFO, overseeing one of the largest social security funds and driving systematic reforms. Bringing over 2 decades of rich cross-sectoral experience, Mr. Pandey combines integrity, vision, and deep financial expertise to strengthen India's social security and pension landscape. Sir, we welcome you to the dais. Next is Mr. Ashok Kumar Soni. Sir is currently serving as the Executive Director at PFRDA. Here, he is responsible for overseeing pension fund regulations and supervision department. A chartered accountant by profession, Mr. Soni brings with him a strong foundation in finance and investments. Before joining PFRDA, Sir was associated with Investment Department of LIC of India, Mumbai. Sir, we welcome you to the dais. Now, I invite Mr. Pranay Ranjan Dwivedi, MD and CEO, SBI Pension Funds Private Limited. With over 32 years of experience in banking and financial services, Mr. Dwivedi has held key leadership roles across retail, SME, agricultural finance, risk management, mutual funds, insurance, and pensions during his career at SBI. Now is Mr. Sriram Iyer, who is MD and CEO of HDFC Pension Fund Management Company Limited. With over 30 years of experience in banking and financial services, Mr. Iyer has led across banking, capital markets, and investment products. Sir was recognized among the top 20 pension fund executives in Asia 2023 by Asian Investor. Sir, we welcome you to the board. Shri Sumit Mohindra is the CEO of ICICI Prudential Pension Funds Management Company Limited. With over 20 years of experience in financial services and life insurance, Mr. Mohindra has expertise in integrating people, technology, and processes to achieve business goals. Now is Mr. Sumit Shukla, who is MD and CEO of Axis Pension Fund Management Limited. Mr. Shukla brings 20 plus years of financial experience with leadership roles at HDFC Pension, HDFC Life, American Express, and Kotak Mahindra Bank. At HDFC Pension, he was instrumental in scaling it into India's largest pension fund manager. His expertise spans business strategy, distribution, and product innovation. Sir, we welcome you to the dais. Without further delay, let's get started. Please join me in welcoming our panelists. Let's give them a huge round of applause. Now, may I request Shri Sanjay Pandey to set the context of the session. Please, sir.
Good afternoon, distinguished delegates, stakeholders of PFRDA unique unbundled architecture, my esteemed colleagues. It gives me great pleasure to interact with you on the occasion of NPS Diwas, which symbolizes collective commitment towards building a pension-inclusive society. Over the past 2 decades, NPS has matured into a robust retirement savings platform, touching the lives of millions of subscribers across government, corporate, and retail, with AUM exceeding 15 lakh crore. Out of this, the non-government sector accounts for around 8% of total NPS subscribers. Non-government subscribers contribute nearly 22% of the total AUM, growing at an impressive 29% year on year. Still, a large segment of the Indian workforce, particularly in the unorganized and informal sector, remains outside the ambit of any formal pension scheme. This is a challenge when people are living longer. It's expected that by 2050, 1 in 5 Indians will be over 60 years of age. And the old age dependency ratio will rise to nearly 30% by 2050. Another great challenge is that women live longer than men, yet they account for only a quarter of NPS subscribers in the private sector. This highlights a gender gap in the retirement preparedness. So these are the challenges in which we have to work. And in this context, it's my privilege to start this important session on the launch of PF schemes under the multiple scheme framework. I'll first devote the attention to the NPS subscribers. Till now, they were restricted with a single investment choice. If you have opted for active choice or auto choice, it's a single choice, and then you can choose your investment partner, but then you have to put all your funds into one basket. This limited their ability to diversify or align investments with varied returns and risk appetites. We expect that the multiple scheme framework, MSF in short, would address this gap. Why? Because MSF allows the subscriber to invest in multiple schemes, onboard more than one CRA. Yeah, that's also true, because this is what was happening till now, that you can only be, your plan can be a part of only one CRA. For subscribers, in that sense, MSF represents empowerment. It provides them greater choice, flexibility, and life stage alignment planning. Now for the pension funds, MSF also empowers them to design differentiated schemes. You are aware that presently the pension funds were operating within the what we call the common schemes, and they were, whatever subscriber would choose them, they would invest for on behalf of the subscriber. Now they can design their own schemes. They can expand coverage in the non-government sector where the need is most urgent, be it corporate employee, self-employed, women, or digital platform worker, and all that within a robust regulatory architecture. This opens the door to innovation, expansion, and ability to reach unserved segments. It fosters healthy competition among the PF scheme managers to perform and innovate, and ultimately deliver better risk-adjusted returns over the long term. Now the interesting part is that MSF builds upon, rather than replacing the existing NPS framework. It enhances transparency through scheme-level reporting, making the system more subscriber-friendly. In essence, MSF modernizes NPS while leveraging the existing ecosystem of CRAs, trustee banks, and POPs. Therefore, MSF is critical to expand pension coverage, strengthen adequacy, and ensure old age financial security. We are deeply honored that the Honorable Finance Minister Madam in the evening shall formally launch schemes of the various pension funds, and I'm happy to note that all the pension funds have brought out the schemes for our consideration, and all of them are willing to go ahead with these innovations under the multiple scheme framework. This will mark a major milestone in our ongoing efforts to enhance the depth and dynamism of the pension ecosystem in India. With this background, I look forward to hearing the perspective of our esteemed panelists, the leaders from the pension fund industry, on how MSF can be leveraged to build a stronger, more inclusive, retirement ecosystem for our country. As I heard, I was hearing the panelist in the last session, he told about that there's a need for predictability, liquidity, safety of returns, and then somebody also talked about that we need to understand how the mutual fund industry have worked out. So I think these are the pointers. These are the pointers for all the pension funds today, that they have to also, apart from providing a good scheme, they also have to market that scheme very well. So through this session, we hope to address several key themes, including how pension funds are approaching product differentiation under MSF, the investment strategies and risk frameworks being considered, how subscriber communication and onboarding will be handled, what kind of industry regulator collaboration is needed to ensure smooth execution. Now, because of the time paucity, we could not bring all our pension funds here, but they would get a chance to showcase their products when we have the formal inauguration. And I would now like to invite our distinguished panelists to introduce themselves and share their thoughts. Now I hand over to Shri Ashok Kumar Soni, Executive Director, PFRDA, who will moderate this session. Thank you once again for joining us today. Thank you.
Yeah, thank you, sir, and good afternoon, everyone. As you are aware, PFRDA has permitted pension fund first time to launch their own specialized risk-based schemes under multiple scheme frameworks. Why it was needed, WTM Financer already spoke about actually. The scheme will have two risk variants, the moderate and the high, where equity allocations allowed up to 100% in the high risk category. PFM may also introduce low risk variant if they want actually. Why, with this introduction of MSF, pension fund have a unique opportunity to design innovative, low cost and the persona-based solutions for millions of individuals outside the government sectors. So this is for non-government sector only. Be it is a digital economy workers, be it is a self-employed or a corporate employees. The low-cost feature of the NPS is maintained under these schemes, MSF scheme as well, where charges for the fund management and the distributions is capped at 30 basis point only. The PF schemes launched under MSF will come with a vesting period of 15 years, ensuring long-term discipline in saving while keeping with the evolving need of early retirements. So since we have running short of time, so straight away I jump to the question to all the pension funds. Topic is same, so my question will be same for all the pension funds. Let's start with the scheme design, sir. So under a multiple scheme frameworks, each pension fund can offer a scheme across risk profile and the asset allocations. The frameworks allow all of you tailoring schemes to the different subscriber persona. So my question is, how will you differentiate your offering for a corporate employee, a self-employed professional, or a digital platform worker like Zomato's? Could you please share your approach, sir? I request Sri Ram Iyer to start with, sir.
Thank you for this opportunity. Very, very happy NPS Diwas to all of the attendees here. So I think, sir, there are three levers that a pension fund has to essentially create differentiation. One is, of course, creating products basis persona, but those products will have to align with what is the risk appetite of the individual. So there is, of course, this whole asset allocation that will decide what the risk appetite, the asset allocation will essentially be framed basis the risk appetite of the individual. So that's one lever that we have. The second lever that we have is in terms of the deaccumulation strategies. For a long time, I think pension funds have by and large focused on maximizing the corpus. I think the new MSF framework also has nudged, and I think the first technical session today spoke in detail about a number of models, and I think the paper that's been created by the PFRDA, the two of PFRDAs, and we heard about some glimpses of this consultation paper that they put out. It will be very interesting to see how pension funds can use some of those inputs and insights, not just from this, but also from global examples that were cited, the Brazil example, the Mexico example, to make sure that we are able to customize products which are, focused on the deaccumulation. So one is the asset allocation, and therefore different strokes for different folks, if I were to use that word. You can actually create a kind of a Spotify playlist for an individual, right, in terms of different schemes. The third thing, and I think it's a very important addition in the MSF guidelines that we saw, actually the first point, which talks about, the value-added services. Thus far, pension funds were largely focused on essentially maximizing, helping clients maximize returns through delivering superior risk-adjusted returns, and that was by and large the big focus. And of course, some of us also had a distribution capability. But now we can actually package the pension product with a number of other allied retirement adjacent products. So these are the three levers that will be available. And I think a combination of these three levers, I think, will be done by each of the pension funds. So for instance, as the Madam Finance Minister will unveil during the later part of the day today, HDFC Pension has created a product which is suitable for the gig worker. We believe that it addresses the key requirements of that segment, and therefore, those kind of products, and I'm sure each of the other pension funds have also, created products which are suitable to a certain persona. So I think you're going to see a lot of innovation, essentially driven around these three levers, is the point that I wanted to make, sir. Thank you.
Yeah, so I think picking up from where Shriram has said, it opens up a lot of opportunity for being innovative, and I think bundling of the product is something that we have to explore, because pension is a very boring product per se, if you go and talk to a customer. But if you try to build in with some of the things which take care of his old retirement age need, which is a pension product, what can happen adjacent to it? So maybe like for a woman customer, we can have a product which will take care of her retirement in any case. Can we bundle, there is a lot of incidents of women suffering from cancer these days of multiple types. Can we build a cancer care for women, which attract them? So if they are, saving, retirement is taken care of. In an unfortunate circumstances, if something happens to her, at least there is some money which is coming, which is taking care of her retirement need or whatever need she may have at that point of time. So I think more of innovation, bundling products across, and we are very excited because we work for a bank. There are so many products that the bank sells today where we can piggyback on them and build retirement as a combo to do it. Like the product that we go to unveil today in the evening, what we have built in it with it is any contribution that the customer is making, we are offering them 100 times the cover. So in the case of any accidental death, partial disability or full disability, 100 times of whatever he's contributed, we will cover up to 50 lakhs. So these kind of innovations will attract a lot of people to come and buy a pension product and make NPS even more, talked about than what it is today.
So being a biggest pension fund in our ecosystem, sir, what should be your approach actually?
Good evening. First of all, I congratulate PFRDA, the entire team, for launching this MSF, which is going to be a real game changer. So earlier we had only limited vanilla kind of products, and with this MSF, there's a complete shift from the approach one size fits all to a more market-driven framework. And certainly, as you talked about the risk profile and different category of customers, a subscriber, 18 years of age, in a IT professional in Bangalore will have completely different requirement than a gig worker of 50 years in Ludhiana. So now with this MSF, we can cater to the requirement of everybody, like corporate employees, young employees, they would like to go with 100% equity schemes. For self-employed persons who don't have regular source of income, but they have greater flexibility and more risk appetite, they can be offered different range of services from 100% equity in their peak earning age to a more balanced kind of fund if they want simplicity. As far as gig workers are concerned, so the approach would be quite different. They are more concerned with simple onboarding, frequent and small contributions, simple language to understand their language. So we are going to use all these product options, innovate and cater to the requirement of all our subscribers.
What's your approach, Sumit? Sir, most of it has already been covered. I'll just talk about a couple of points. One, I believe, like everybody is saying, this is a game-changing product, primarily from the point of view, because if you look at NPS today, it provides a whole lot of flexibility and choices, whether it's a choice of CRA, choice of PFM, so on and so forth. The only place probably where there was not so much of choice was on the scheme itself, which is where now the MSF will give that opportunity to customers to choose a variety of various risk-based, depending on the risk appetite, they can put some money in a high risk, some money in a moderate risk, some money in a low risk. So that gives a good amount of diversification to each of the subscribers. The other thing was that today we talk one language to everybody. So now with persona-based focus, actually it will help the pension funds also to be more focused and look at segments which have technically not been looked at before. So it will make the whole approach very focused. To be very honest, since we never had this before, we also are going to learn along the way. We don't have the product capability in terms of proper marketing or creating a blitz like some of what we've seen in the other industries. But we are extremely excited about it, and we'll not take too much time in building that up. But this presents a great opportunity to connect with every Indian and offer something that will connect with them and come on to the boardwalk of pension planning.
Oh, thank you. So moving to the crucial area of risk management. With the equity allocations now permitted up to 100%, how do you plan to optimize risk-adjusted return while safeguarding subscriber interest and the aspiration, given the inherent risk of market volatility? So let's start with the Sriram actually. How do you?
So I think the biggest moat that we have to manage risk is the vesting period of 15 years. I think, the fact that, a subscriber will need to willy-nilly stay invested for a period of 15 years, and of course there is an option for the investor to move out and move into a common scheme. But the reality is that 15 years is a very, very meaningfully long enough time for us to make sure that even in a 100% equity scheme, there is minimal, actually, if you look at the Nifty 50 and look at 15-year rolling returns since inception, there has never been an instance where the returns have been negative. In fact, 100% of the times the returns have been more than 8% per annum, right? So if that's that's the fundamental nature of equity as an asset class, I think that's the biggest moat that we have. Secondly, I think, there is a clear definition that PFRDA has in terms of exposure at an overall level, in terms of the number of stocks that we can take exposure to, not number of stocks, but in terms of the universe, and of course in terms of the various other boundary conditions that have been defined. So I think from that perspective, there is a fair bit of risk management capability that already exists. In fact, if you look at the scheme size, some of us manage schemes which are actually in the top 5, top 10. HDFC Pension Equity Tier 1 Fund is today the 5th largest scheme in the entire actively managed universe, right? So there is already capability to manage that kind of risk, because that in itself, you're doing it already. Finally, I'd like to say that volatility is temporary, compounding is permanent, right? And I think that's something that we need to be able to educate investors around and make sure that we are able to communicate the power of long-term staying invested for long periods of time. So I don't think the volatility risk of equity is going to go away. We have a duty as pension fund managers to make sure that we don't take calls which are completely at the edge, which I think PFRDA has played and NPS Trust has played a very, very meaningful role in making sure that there is a constant quarterly sort of review of performance, and that keeps us also completely aligned to the broad framework that's been designed, and I think that will continue. And I think all of these together will make sure that we are able to deliver superior risk-adjusted return, even if there is a 100% allocation to equity, sir.
Thanks. So
on the risk-adjusted returns, sir, what I would also like to highlight is, in the last 10-15 years, we have created a very strong investment teams within all pension funds, and we have a strong track record of performance across pension funds. very, very strong leadership at a CIO level that we have provided, and they have learned the pension investment the hard way, because they have seen multiple cycles, and some of them have been there for mostly 5 to 10 years. So that gives me a lot of confidence that we don't have to be very worried from a risk-adjusted return, that the best-in-class investment managers are going to manage. And to add to that, sir, if you look at the investment committees of the board of some of the pension funds, it's filled with illustrious people who have had a long investment experience. And I'm very confident that they will keep a close watch into what investments are happening on behalf of the subscriber, and I see no reason that they will not increase the watch after the MSF has come. And to top it all, sir, we have regular reviews from NPS Trust and PFRDA quarterly basis, which will keep a close watch so that the risk is taken care of. So adding to what Shriram has already said, these are few things which give me a lot of confidence that we should be not worried about anything from a risk-adjusted return not being taken care of.
First of all, this is a major reform, 100% equity. Equity by nature is volatile in short term, but in long term, it gives you superior returns, and the volatility evens out in long term. And this compounding gives the heavy lifting. So it's a preferred investment option for the subscribers. Second thing is that we have very, very strict guidelines of PFRDA and follow-up of NPS Trust. And apart from that, we have a strong internal risk framework. So based on that, we are confident that we are going to give very, very good risk-adjusted return to the subscribers. At the same time, subscribers should also understand. And basically, this scheme, MSF, our Jeevan Swarna scheme, which offers 100% equity, is meant for those who understand risk, for the younger generation, who have age on their side, who can ride the volatility, ups and downs of the market. And they should understand also that this is a product for long-term product. So selecting a correct, right subscriber, and with all this framework and guidelines, it is going to be a wonderful tool for the subscriber to build wealth, develop wealth over a period of time.
So just one final point I wanted to add, otherwise everything has been covered. I think one thing that will be required is the communication with the subscriber, because there will be, of course, periods of time when things will be volatile. However, if we have enough modes of communication with the subscriber and he's able to reach out to us, we are able to give him the required information, or my experience is that 70 to 80% of the problem gets solved if the customer feels that he's been heard. And we are able to give those kind of information that he's looking for, the answers that he's looking for. That is something we'll have to invest in quite a bit to ensure that there are multiple modes for a customer to reach out to us. It should be extremely easy for him. He shouldn't have to struggle to put through his complaint, or if there is any question or issue that he's facing. Besides whatever has been discussed, this is one area that we'll have to invest in.
Okay, so my last question actually, how do you see the MSF shaping the pension landscape in India over next 5 to 10 years, especially in the non-government sector? And how do you see the role of the pension fund evolving over the same period in shaping India's retirement ecosystems? So to start with, again, Suriname.
Thanks. So I think there are broadly three things that I think will happen as a result of the launch of this, of MSF as a capability. Number one, I think subscribers will benefit. For a long time, NPS as a product, and of course APY does cater to, to a different segment, but NPS as a product for a long time has been for India and not for Bharat. I think we now have capability to create products which will serve Bharat as well, and I think we saw the example of, the ma'am from Zomato who spoke about so passionately about the, various initiatives that they're taking. So I think NPS gets added to that basket. That's number one. Number two, I think, and therefore subscribers will benefit. I think the fact that, this multiple schemes can be held, as Sumit pointed out, and the fact that you can hold different asset classes, different combination of asset classes, and therefore you basically can create a it's almost like a Spotify playlist that keeps coming back to my mind, right? I mean, as a subscriber, you can actually create a basket of schemes rather than just having to do one scheme to solve all your problems. The second, I think the industry will expand. And I think that's something that we are all very excited about because the pie is going to grow. For a long time, I think we've had around additions of 10 to 12 lakh subscribers over the last few years. We believe that with the unleashing of the MSF platform, that number should multiply. And that's the responsibility is on us. PFRDA, I think, has done its best bit in terms of enabling the infrastructure. I think we are going to be now driving this and making sure that this change is made known to the people at large. Finally, I think one big change, and this is a change that actually struck me when I was thinking about it last night, is that NPS has become a platform and not a product any longer. For a long time, it was a product. Now it has become a platform because it offers you multitude of capabilities, multitude of personas can be catered through it, and it offers you multiple risk-based options, or based on your risk appetite, you can choose, different options. So I think it can bring about a sea change in the way, this business will grow over the next few years, in my opinion, and I think we are all very, very excited about it.
Yeah, so basically when I look at it, particularly since I have been working with a bank now for 3 years on selling NPS, and what I've realized is every bank salesperson has almost got 20, 30 products to talk to a customer. When we went around talking about NPS, they put their entire bouquet, but they were not getting anything exciting to talk about with the customer. So they could make one pitch with the customer, please open an NPS account, this is the way it works, but there is nothing exciting coming out of it. What this gives is something new for the bank salesperson to talk to the customer. Something new has come, some new scheme to talk about, and that was where the clutter will get broken. Where we were suffering from a mutual fund launching a scheme every quarter, we will also have something new to talk to the customer, that we also have these schemes to talk about. Additionally, what I personally believe is with this TER structure that we are moving to, we can actually put some serious investment now in making NPS Zaruri Hai more prominent, being more visible within the bank branches, putting up posters within the ATMs. Everything used to cost a money. Now with this MSF scheme, we can actually go back to our boards, make a plan and start advertising in a big way in the branches, particularly large banks like HDFC Bank, Axis Bank. We have huge number of branches in larger part of the country. So advertising can go up. And last but not the least, we were not able to provide people on the ground. What happens is, for a life insurance partner in a bank, everybody has a sales team which is mapped to every salesperson of the bank. And any lead comes in, it goes to the life insurance person and he goes. We didn't have people even in the region, leave aside being in every branch. Now finally we can think of putting 50, 60, 100 people on the ground, which will go around talking about NPS in different branches, different customer sessions they can do, and that will make NPS much more relevant. Plus, the salespeople in the bank will have somebody to call up. There is a query which has come from the customer about a product, what should I do? So a two-way communication will start, and that will see a lot of multiplier effect coming in. So very excited about it. I think we are going to grow in a very big way in the next 5 to 10 years, and sky is the limit.
So, sir, this MSF has changed the role of pension fund managers from managing fund and marketing products to a real product designer and a market shaper. So we need to innovate, design product, understand the needs of the subscribers and offer them differentiated products. So the role has changed and it is going to certainly help the industry. And I'm confident that NPS is going to be a central pillar of this pension retirement security system of the country. Number only you can tell what is going to be the number, but maybe 1 million in 1 year is not a big number. But the focus should be on the diversification of the subscribers. So the subscribers have to be, basically we would be happy if the subscribers are gig workers, first-time pension fund pensioners, or this self-employed persons. So if the diversification happens, we'll come to know that this MSF is working for all. So we have high hopes.
Sir, I'll just talk about the role of pension funds as I see it. Of course, the responsibility for us now grows multifold. As I said before, it will, one, help us in being more focused ourselves, because we'll have to ensure that we come up with something which is suitable as well as appealing to various segments, so that more and more Indians can join the NPS platform. Secondly, this all has to be done by taking a partnership approach. We have to think of our customer as our partner and not a manufacturer-customer relationship. I'll just quote, last year we made our purpose statement at ICICI, which actually gels in now with all that is happening. So it says to be the most trusted partner, serving Indians to secure their retirement through dynamic and prudent fund management via continuous innovation and service excellence. So all of that we will need to do now, and that is clearly our responsibility, especially with MSF coming in.
We have heard how the pension fund are approaching product differentiations under MSF. We also heard that investment strategy and the risk framework being considered by the pension funds. Design a scheme that truly address the need of the subscriber, from digital economy worker and women investor to the entrepreneurs. From the product innovation to the subscriber-focused design, each pension fund has demonstrated a strong commitment to ensuring that multiple scheme framework is a great success. With this, thank you all once again for joining. So we can now if anybody ask any one or two questions, we can take this pension.
Since this is a new initiative, I think we just have floor open for few questions if anybody would want to ask in regard to the new venture.
You may kindly raise your hand, please.
PFRD approved 23 schemes of the pension fund, which will be available maybe from tomorrow onwards. Each pension fund will have 2 or 3 schemes. Some pension fund have also bunny schemes. So that will be available for subscriber for tomorrow, maybe tomorrow or onward actually. So if anybody want to ask any one or two questions, they can ask it from the pension funds. Otherwise, we close the discussion.
I think there are no questions as of now. So with this, we sincerely thank our esteemed panelists for sharing their valuable insights today. Your expertise and thoughtful contributions have enriched our discussions and provided us with a deeper understanding of the topic. Let's show our appreciation with a round of applause for the wonderful participation. To honor our panelists, I request Shri Ashok Kumar Soni, ED PFRDA, to present a token of appreciation to the dignitaries on the stage. To start with, I would request Soni sir to present a planter to Shri Sanjay Pandey, WTM Finance PFRDA. Now, I would request Soni sir to present a token of appreciation to Shri Pranay Ranjan Dwivedi, CEO SBI Pension Funds. The token may now be presented to Shri Sriram Iyer, CEO of HDFC Pension Management Company Limited. It's time to now present the planter to Shri Sumit Shukla, CEO, Axis Pension Fund Management Limited. We may now present the memento to Shri Sumit Mohindra, CEO, ICICI Prudential Pension Funds Management Company Limited. We would now like to felicitate Shri Ashok Kumar Soni for his excellent moderation of the session, and I request Ms. Kavita Singham Xavier to present a memento, please. With this, we bring the technical session to a close. It's my pleasure to now invite Ms. Mamta Rohit on the stage to present the vote of thanks. Please, ma'am.
Thank you, Jaspreet. Good evening, Chairperson, PFRDA, whole-time members, all dignitaries, ladies and gentlemen. It's my honor to deliver the vote of thanks at the conclusion of today's technical panel sessions, which have both been enriching and thought-provoking. On behalf of PFRDA, I extend my sincere gratitude to all the speakers, panelists, and attendees for making this event a resounding success. We began with a crucial session on the evolving landscape of the decumulation phase in retirement planning. Our heartfelt thanks to Sri Randeep Singh Jakpal, whole-time member law, PFRDA, for his comprehensive context setting which laid the foundation for a rich and engaging panel session. Thank you for sharing your deep insights and diverse perspectives to all the panelists. This session provided insights for the development of more innovative products that could better preserve the retirees' standard of living while maintaining the core advantage of payouts, offering financial predictability and longevity protection. The session 2 on securing old age income for agripreneurs, Laghu Udyami, and platform workers shone a light on the inclusive pension solutions for underserved and emerging segments of our workforce. We sincerely thank Madam Mamta Shankar, whole-time member economics, for her thoughtful context setting. Our appreciation to all our panelists. Your discussions and challenges and solutions in securing income for these sectors were truly inspiring. It's vital to build long-term financial literacy and trust among these sections to ensure continuous participation in NPS for old age security through different platforms. Session on launch of PF schemes under multiple scheme framework marked a significant step forward in pension reforms. Our gratitude to Sri Sanjay Pandey, whole-time member finance PFRDA, for setting the context so excellently. We thank our expert panel as well. Your insights on scheme design and execution will go a long way in shaping the future of pension offerings in India. The reform is a significant step forward in expanding the outreach of NPS in the non-government sector, allowing greater flexibility, more personalized retirement solutions, and alignment with global best practices in pension system design. I thank each and every one of you, our distinguished guests, moderators, panelists, and participants, for your time, attention, and engagement throughout the day. Now, while inviting all of you to high tea, I request your presence for next event at 6 p.m. in this very hall, which is going to be graced by Hon'ble FM herself. I urge all of you to take your seats by 5:30 p.m. positively to participate in the wonderful event set out for phase 2 of the day. Thank you so much.
The plenary session of NPS Diwas 2025 being held under the theme Inclusive Pensions, Innovative Solutions, Strengthening Retirement Security in India. We are very honored that we have with us Shri M. Nagaraju, Secretary, Department of Financial Services, joining us now. Please give him a huge round of applause. We are awaiting our chief guest, Srimati Nirmala Sitharaman, the Honorable Union Minister for Finance, and she will be here with us in just a few minutes. I request everybody to please settle down and take their seats. Please clear the aisles so that we can begin our program expeditiously. I request all of you to please settle down. Economic Advisor to the Government of India. We are very happy to welcome him to this plenary session of the NPS Diwas 2025. I request everybody to please take their seats. We will begin with the program very shortly. I request all of you to please clear the aisles. Patients, we have an action-packed evening coming up. In the plenary session of the NPS Diwas 2025, there is lots coming up, and I'm sure all of you are very eager to start with the program. It'll just take a few minutes more. We are expecting our chief guest to arrive in just a couple of minutes. Thank you all for your patience. I request all of you to please settle down and take your seats. A very warm welcome to all of you to this landmark occasion, the plenary session of NPS Diwas 2025, being held under the theme Inclusive Pension, Innovative Solutions, Strengthening Retirement Security in India. I request everybody to please settle down and take their seats. And if anybody is closer to the door, request you to please clear the aisles. We are expecting our chief guest to come in any moment now. So I request everybody to be seated and please put your phones on silent. Ladies and gentlemen, please give a huge round of applause to welcome our chief guest, Srimati Nirmala Sitharaman, the Honorable Union Minister for Finance. तालियों की गड़गड़ाहट से माननीय वित्त मंत्री का स्वागत करिए. Request all of you to give a thunderous applause to our chief guest, Srimati Nirmala Sitharaman, the Honorable Union Minister for Finance. I would also request our other dignitaries, Dr. V. Ananthanageshwaran, Chief Economic Advisor to the Government of India, Shri M. Nagaraju, Secretary, Department of Financial Services, and Shri S. Raman, Chairperson, PFRDA, to please come up on stage. Please give them all a huge round of applause. To mark the auspicious beginning of this plenary, may I request the Honorable Finance Minister and the dignitaries on the dais to kindly move forward for the lighting of the ceremonial lamp. The light of the lamp symbolizes knowledge, security, and a bright future. Thank you, ma'am, and thank you to our dignitaries for initiating this auspicious beginning to the event. We have an action-packed evening coming up with lots of good news coming in for those wanting to subscribe to NPS schemes, for MSMEs, for FPOs. There's a lot coming up in the evening today. May I now invite Shri S. Raman, Chairperson, PFRD, to please deliver the welcome address. Please give a huge round of applause to Shri S. Raman.
The Honorable Minister for Finance and Corporate Affairs, Secretary, Financial Services, the Chief Economic Advisor, dignitaries of the dais, ladies and gentlemen. It is my privilege to be here today in the august presence of the Honorable Finance Minister to celebrate NPS Diwas, a significant day dedicated to the national pension system, one of India's most robust and exclusive retirement schemes. The preamble to the PFRD Act 2013 inter alia sets out the objectives of providing old age income security in India, which is of vital importance as the demography of the country is expected to change. NPS was launched by Government of India with the vision of providing every Indian citizen an opportunity to build a solid financial foundation for their future. At present, NPS has more than 9 crore subscribers, an AUM of about 15.5 crores as on 31st August, with a very presentable CAGR, or a return from the market, of more than 9% over the last 14 years. Atal Pension Yojana was launched in the year 2015 by the Honorable Prime Minister, and the scheme is implemented with a focus on the unorganized sector and has shown remarkable growth in coverage with more than 8.25 crore enrollments. The NPS Vatsalya scheme is a key step towards inclusive pension coverage, enabling guardians to create a regulated long-term corpus for minors and dependents. It ensures financial dignity through a specialized pension payout and serves as an effective, legally protected and tax-efficient succession planning tool. Considering the vast uncovered population of the country, a lot more needs to be done. The major challenge in extending NPS to all citizens is increasing awareness and financial literacy among potential subscribers. We must focus on providing ease of onboarding to the subscribers across all strata of society. Recognizing the need to strengthen India's pension landscape and to bring within its ambit a wider spectrum of contributors, the PFRDA is pleased to introduce the multiple scheme framework. This reform is a significant step forward in expanding the outreach of NPS in the non-government sector, allowing greater flexibility, more personalized retirement solutions, and aligned with global best practices in pension system design. In the current regime, improving the payouts under NPS is crucial to make the scheme a truly viable retirement solution. With rising life expectancy and inflation, the existing annuity returns often fall short of covering post-retirement needs. Enhancing payouts either through better payout products, greater flexibility in withdrawals, or improved returns. It also boosts public confidence in NPS, making it a more attractive and sustainable long-term social security tool. To realize the long-term goals of Viksit Bharat 2047, achieving a fully pension society is essential. Channelizing NPS savings into infrastructure, startups, and growth sectors can significantly enhance returns for subscribers through market-linked growth and compounding. By aligning long-term pension funds with nation-building investments, subscribers benefit from higher wealth creation while the economy gains vital capital. Evolving pensions towards market-funded models fosters a pension society that is financially secure, resilient, and less dependent on government support. By encouraging individuals to take ownership of their retirement through schemes like NPS, we promote a culture of financial responsibility, long-term savings, and dignity in old age. This shift not only reduces fiscal pressure on the state, but also ensures inclusive and sustainable social security for all. Let us remember that the best time to start planning for tomorrow is today. On this NPS Diwas, I urge everyone to take a moment to reflect on their financial goals and explore the possibilities offered by the NPS, the National Pension System. The future is uncertain, but with right planning, we can ensure it is secure. I once again thank the Honorable Finance Minister to be here and welcome all of you guests. Thank you.
Thank you, sir. May I request Dr. V. Ananthanageshwaran, Chief Economic Advisor, to kindly deliver his special address. Please give a huge round of applause to Dr. Nageshwaran.
Honorable Finance Minister, Secretary, Department of Financial Services, Chairperson, PFRDA, distinguished ladies and gentlemen, members of the PFRDA, thank you for having me here to share my thoughts. I think it's important that we do celebrate the Pensions Day every year. I understand that this is the 5th such occasion, and it is a good opportunity to remind ourselves of the enormous responsibility that we have towards the population at large, and also to remind them of the importance of savings. If you look at the data, The world population 60 years and above is expected to double between 2015 and 2050, from 12% to almost 24%, roughly put 22% of the world population by 2050 will be over 60 years of age. In India also, population 60 years and above in 2011 was 10.4 crores, and it will increase to almost 32 crores by 2050 based on published studies. And as people live longer and they age, naturally the life cycle or the lifetime savings will be an important component of how well they can maintain their standard of living and lead a life of dignity. But obviously demographic changes and also lifestyle changes and choices are making people feel that saving is something they can wait and postpone to a later date, while the consumption choices available today make them use future savings for today's consumption, whereas saving is all about deferring today's consumption for future consumption. And this is a mindset shift that PFRDA or the government or the social leaders at large have to confront. But savings itself is eventually a function of income growth, which in turn is a function of economic growth. And that is what the government has been focused on providing in the last 11 years. Especially if you look at this year, the February budget gave a significant direct tax cut for the public at large. And then more recently, the indirect tax reduction has happened. And both these together will leave a lot of disposable income in the hands of the public, which means the savings rate can increase, and it's important for pension schemes to be made available to them, and for them to tap into it, you need savings, and that is what these two tax reductions deliver. The other thing that the government has done is also to ensure that over the last 11 years, inflation rate on average in India has been coming down to now under 4%, and the central bank expects it to remain below 4% for next year as well. So in other words, having price stability is also a means of putting disposable income in the hands of people, from which savings can therefore be multiplied. And then the ability to maintain economic growth, if you look at the post-COVID situation in several countries, the kind of growth rate that India has been able to maintain in the last 5 years. And just today, the Reserve Bank of India also upgraded the growth numbers for 25-26. Now, I'm spending enough time to talk about this because ultimately, savings is a function of income growth, function of employment growth, which is a function of economic growth. And therefore, the government's responsibility is not only to create savings products, incentivize savings, which we have been doing, starting from NPS Vatsalya to Atal Pension Yojana for unorganized workers, and setting up the different pension options for civil government employees as well. These are all important operational level changes. But the fundamental driver of savings and pensions is economic growth, employment and income growth, and that is what the government has been striving to achieve over the last 11 years and successfully too as well, even as the environment becomes more and more challenging in the external world. The endeavor has been to continue to support domestic growth so that more and more people can find their livelihood enhanced, either through employment or through entrepreneurship. Therefore, our job is to make the job of PFRDA easier by inculcating the habit of savings through income generation. And the policy framework is very well geared towards enabling that to happen. And I therefore, on this occasion, I wish the PFRDA, its members, and the organization, the staff, to continue to do the work of inculcating the habit of putting away a small sum for the rainy day, because they have a task on their hand in terms of convincing the younger generation, while we, on the policy side, led by the Honorable Finance Minister, will continue to provide the macroeconomic framework to sustain income and savings growth. With those words, I once again thank PFRDA for inviting me to be present with you on this important and august occasion and to be able to share my thoughts with you. Wishing you all a very happy Navratri and Dussehra and a happy Deepavali season ahead. Thank you very much.
Thank you, sir. I would now like to invite Shri M. Nagaraju, Secretary DFS, to share his words with the audience. Please give a round of applause to Shri M. Nagaraju.
Honorable Finance Minister, my colleague Dr. Ananthanageshwaran, Chief Economic Advisor, Sri Raman, Chairman PFRDA, and all the distinguished participants. Good evening to you all. I am very happy to be here on the occasion of NPS Diwas. You know, I think all of us are aware, pension is a matter of great importance and deep relevance in Indian context. As we navigate through the complexities of our evolving socio-economic landscape, the role of pensions in securing the future for our elderly citizens is very, very crucial. The relevance and importance of the NPS scheme lies in the evolving demography of India. The demographic composition of India is changing. It is estimated that the proportion of elderly population is expected to be 20% in 2050, and old age dependency ratio is also expected to increase to 32% in 2050. Traditionally, in India, multi-generational households were the norm, with elders living with their children and grandchildren in a joint family system. But this is changing now. This signifies that we are going through rapid social and cultural change impacting post-retirement life. In addition to these social challenges, it has been seen that savings or investments for creating pension corpus is of less priority in financial planning of individuals. The proportion of financial savings in provident and pension funds by households in their gross financial saving is still very, very low. Such pattern of financial behavior of individuals makes it more challenging in onboarding people for pension-related products. The NPS offers a high degree of flexibility to its subscribers, allowing them to tailor their retirement savings and investment choices according to their risk appetite, financial goals, and needs. All of these socio-economic factors underscore the need for vibrant and comprehensive pensions ecosystem. And to achieve it, the Government of India has taken several initiatives. This includes enhancement of the mandatory contribution by the central government and freedom of choice for selection of pension funds and investment pattern to its employees covered under NPS. Introduction of UPS, which will provide the central government employees with the assured pension along with the introduction of various pension schemes catering to different sections and age groups. The scheme will benefit around 25 lakh central government employees. State governments also have the option to adopt UPS as per their choice. The scheme has features of both defined contribution and defined benefit. Furthermore, to provide further flexibility and choice to the central government employees, a one-time switch from UPS to NPS has also been approved by Hon'ble Finance Minister and which has been notified. Flagship scheme, pension schemes of Government of India, APY has proved a landmark scheme in Indian pension space with its unique features and significant coverage. Although a lot needs to be done to achieve the pension saturation in our country, the current enrollment in APY is skewed towards pension slab of 1,000 rupees. However, we need to nudge the subscribers towards higher pension slabs. On account of the attractiveness of the scheme, total enrollment in APY so far has reached 8.25 crore with the assets under management of rupees 47,971 crore. Currently, The subscriber consists of 48% females and 52% males. With the launch of NPS Vatsalya scheme, NPS now is available for subscription from newly born child to 70-year-old elder man. During the last 10 years, the pension corpus of NPS has grown with a CAGR of 34% from AUM of 80,853 crores as on 31st March 2015 to AUM of 14,43,000 crores as on 31st March 2025. At present, NPS has more than 9 crore subscribers and AUM of 15.48 lakh crores as on August 31st, 2025, with remarkable returns of more than 9% on an average since its inception. These initiatives have been taken towards making India a pension society. It shows that pension returns are robust and very attractive. Despite these achievements, several challenges persist. Historically, pensions were largely confined to government employees and a few organized sectors, leaving a substantial portion of workforce uncovered. RBI NCFE Financial Literacy Survey for India suggests that only 25% of people are planning their retirement savings. Other challenges include ensuring adequacy of pension to provide sufficient old age income to meet the needs of retirees, safeguarding the investment, prudent fund management, and effective administration of pension scheme. To address these challenges and build a more robust pension ecosystem, we should continue to take efforts to include more workers from the informal sector and non-governmental sector into pension fold. Comprehensive financial education and literacy campaigns targeted towards pensioners are implemented to raise awareness about the importance of retirement planning and the benefits of participation in pension schemes. Use of technology in improving the accessibility and efficiency of pension services, digital platforms can simplify transactions, enhance transparency, and provide real-time information to beneficiaries. Understanding that strong and robust regulatory frameworks are essential to ensure the sound management of pension funds and to ensure to the integrity of the system. PFRDA has been consistently working on strengthening regulation and oversight functions, and we applaud it for that. As announced in the Union Budget 2025-26 by the Honorable Finance Minister, a forum for regulatory coordination and development of pension products has been set up to act as a platform for harmonizing regulatory practices, investment standards across pension products, strengthening consumer protection, grievance redressal, and ensuring robust systemic risk management of assets under management. This forum aims to ensure regulatory consistency for transparency and predictability, empowering the subscribers through facilitation of portability, strengthening consumer protection, and robust grievance redressal system. Development of pension market through product development and advocacy, creation of awareness among the subscribers towards pensions as a financial product. Today, the pension sector in India is at a critical juncture. Despite several challenges, recent reforms have expanded the scope of pension coverage, aiming to create a more robust system. As we endeavor to build a more inclusive and sustainable pension system, it is imperative that all stakeholders, government, employers, financial institutions, and individuals collaborate effectively. I am certain that with a collective and collaborative approach, we can create a pension system that not only meets the needs of today's societies, but also safeguard their future financial needs. I congratulate PFRDA and all the stakeholders, employees, government departments, banks, investment managers, employers, for trying to create India's pension ecosystem, stronger, fairer, and inclusive. Thank you. Jai Hind.
Thank you, sir, for your perspective. We now come to the highlight of the evening, the ceremonial launches and releases, each reflecting new chapter in the expansion and growth of the National Pension Scheme, National Pension System, NPS. Our first launch is the Multiple Scheme Framework, MSF, under NPS. under MSF, each subscriber can now invest in multiple NPS schemes under a PRAN linked to PAN, allowing greater diversification and flexibility. Under this PFRDA initiative, pension funds will be allowed to introduce pension schemes tailored to different subscriber personas such as professionals, entrepreneurs, corporate employees, women, and platform workers. We are pleased to announce that today, all the 10 pension funds are launching the first set of schemes under this framework. This reform strengthens NPS as a globally benchmark pension system that is flexible, inclusive, and future-ready. May I humbly request our Chief Guest, Honorable Union Finance Minister, Srimati Nirmala Sitharaman, to formally launch these new pension schemes under the multiple scheme framework of NPS. Now, I will request the pension fund heads to please come forward for the release of the scheme document. Please welcome on stage Mr. Pranay Ranjan Dwivedi, SBI Pension Funds Private Limited. SBI Pension Fund is launching Jeevan Swarna Retirement Yojana, Life's Golden Plan. This is a high equity fund to help build investors a robust corpus on retirement. Thank you. I would now like to invite on stage Mr. Pankaj Saxena, LIC Pension Fund Limited. LIC is launching NPS Smart Balance Tier 1 scheme. This scheme balances stability with growth with up to 85% equity component. I request next Mr. Umesh Gupta of UTI Pension Fund to please come up on stage. UTI Wealth Builder NPS Equity Scheme is being launched today. UTI NPS Fund will focus on growth opportunities in the equity space. Thank you. Next, I would like to invite on stage Mr. Sriram Iyer, HDFC Pension Fund Management Limited. HDFC Pension Fund is coming out with NPS Surakshit Income Fund tailored for digital economy platform workers. Thank you. Next, I would like to invite on stage Mr. Sumit Mohindra, ICICI Prudential Pension Fund Management Limited. ICICI Pension Fund is launching NPS My Family, My Future Fund, which aims to empower women to help them build a corpus for a secure future of their loved ones. Thank you. Please welcome on stage Mr. Nilesh Bharkhara of Kotak Mahindra Pension Fund. Kotak Mahindra Pension Fund is launching NPS Kuber Equity Fund, a high equity fund with a focus on self-employed individuals. Thank you. I would like to invite on stage Mr. Vikas Seth of Aditya Birla Sun Life Pension Fund Management Limited. Aditya Birla is launching Secure Retirement Equity Fund, NPS scheme. This is built for professionals and corporate salaried individuals to deliver high growth with stable returns. Thank you. I would like to invite on stage Mr. Kurian Jose, Tata Pension Fund Management Limited. Tata Pension Fund is coming out with NPS Smart Retirement Fund. This is a high-growth equity fund for professionals, salaried individuals, and entrepreneurs for disciplined retirement planning. Next, I would like to invite Mr. Sumit Shukla, Axis Pension Fund Management Limited. Axis Pension Fund is launching NPS Golden Years Fund Growth, specifically designed for Axis Bank customers. This scheme has been developed for high-risk appetite investors for building a comfortable retirement corpus. Thank you. And now I would like to invite Mr. Rahul Bhagat, DSP Pension Fund Managers Private Limited. DSP Pension Fund has come out with NPS Long-Term Equity Fund. This is a high equity fund with a goal of long-term growth of retirement savings. Thank you. Thank you, ma'am, and thank you to our dignitaries. I request you to please take your seats. Pension funds have prepared short videos on the pension schemes being launched today. These videos provide the details of the scheme. So I request all of you to please train your eyes to the screen and watch these videos.
Cost charges up to 0.30% of AUM per annum. Our tax benefits is NPS Diwas. Let your retirement grow as fast as your ambitions.
Axis Pension Fund presents Axis NPS Golden Years Fund Growth, an optimized solution for your retirement, turning your life's work into life's reward. Being 18 or above is all it takes to become a subscriber today. Your 15-year bridge to a brighter retirement. Turning life's uncertainties into peace of mind with cover up to rupees 50 lakhs. Flexibility to switch, freedom to grow towards your retirement. Available at all POPs including all branches of Axis Bank. Subscribe today.
UTI Pension Fund presents UTI PF Wealth Builder, NPS Equity Scheme, a retirement fund under PFRDA's multiple scheme framework. Ideal investors, young and mid-career professionals seeking mid-cap equity growth, investors with high-risk appetite, planning to maximize their retirement corpus. Scheme features and benefits. Minimum vesting period, 15 years, investing up to 100% in equities in Tier 1 account. Invest in high-potential mid-cap companies. Asset allocation.
सालों से महिलाओं ने ऐसे ही बचाया है, थोड़ा थोड़ा करके। कितना अच्छा हो जब ये छोटी बचत बच्चे की एजुकेशन का सपोर्ट सिस्टम बन जाए। कभी इन्हीं बचत से अपने माँ बाप या सास ससुर के लिए अच्छी हेल्थ केयर फैसिलिटीज़ अरेंज हो जाएं और कभी अपने पति के सपनों में बड़ा योगदान कर जाएं। ICICI NPS माई फैमिली माई फ्यूचर के साथ अब महिलाएं अपनी रोज़ की छोटी बचत को बना सकती हैं कल के बड़े माइलस्टोन्स। ICICI NPS माई फैमिली माई फ्यूचर, आज की बचत कल के सपने।
The scheme is specially designed for the self-employed individuals.
LIC Pension Fund introduces the LIC PFL NPS Smart Balance Tier 1, a hybrid scheme designed for long-term investors with a high-risk appetite. It strategically blends 65% to 85% in equities for growth with a debt component for stability. As part of the multiple scheme framework, it offers greater flexibility. LIC Pension Fund Limited, financially secured, dignity assured. Please read all scheme-related documents carefully before investing.
Under the multiple scheme framework, SBI Pension Funds has launched the Jeevan Swarna Retirement Yojana. Unlock higher potential for long-term wealth creation with up to 200% allocation to equity through this 15-year pension plan that is tax-efficient, low-cost, and well-regulated. This retirement plan is ideal for corporate employees, salaried and self-employed individuals, professionals, and HNIs. Partner with India's largest pension fund and secure your future the smarter way.
Under the new multiple scheme framework by PFRDA, a new era for NPS begins. HDFC Pension proudly introduces the HDFC Pension NPS Surakshit Income Fund, a unique scheme designed to secure the future of India's digital economy workforce. HDFC Pension, your NPS, your way. Be future sure.
We are confident these videos must have generated curiosity and excitement among all participants about new investment avenues now available under NPS for professionals, entrepreneurs, corporate employees, women and platform workers alike. Next, we move on to a landmark initiative, the symbolic distribution of permanent retirement account numbers, PRAN card, under NPS to platform workers. India's gig and platform economy is projected to reach 61 million workers by 2047. Until now, most of them have remained outside the formal social security nets. To bridge this gap, NPS platform workers model was introduced and the pilot was launched with Zomato, HDFC Pension Fund has implemented an NPS Suraksha Income Fund scheme, and the fully digital enrollment journey has been enabled by K-Fintech CRA. This model is entirely digital, providing a seamless interface. Zomato deserves special mention here as the first aggregator in India to operationalize NPS for its delivery partners. The pilot has already witnessed overwhelming response, with more than 60,000 Zomato delivery partners giving their consent to join the NPS. Now I will request the Honorable Finance Minister and our other dignitaries on the stage to kindly come forward for the symbolic distribution of prans to Zomato delivery partners. I would also like to invite on stage Mr. Aditya Mangla, CEO Zomato, Mr. Sriram Iyer, MD and CEO HDFC Pension Fund, and Mr. Shrikant Nadella, CEO K-Fintech CRA, to join the Honorable Finance Minister for this historic moment. मैं ज़ोमैटो डिलीवरी पार्टनर से अनुरोध करती हूँ कि कृपया मंच पर आए जब मैं उनके नाम लेती हूँ. Please welcome on stage Mr. Praveen. Please welcome Mr. Gaurav Kumar. Please welcome Mr. Hari Shankar Sharma. Please welcome Mr. Tushar Barman. Please welcome Mr. Jata Shankar Sahu. Thank you to our dignitaries for presenting the pran numbers. And thank you to Mr. Aditya Mangla, Mr. Sri Ramayar, and Mr. Shrikant Nadella. Witness the MOU exchange between PFRDA and NABARD for creating awareness and capacity building for farmer members through farmer producer organizations, the FPOs. I would like to invite on stage Shri Shaji KV, Chairman NABARD, for the MOU exchange. With over 45,000 FPOs across India and nearly 100 lakh farmers as members, we are enabling FPOs to act as pension agents to facilitate enrollment of small and marginal farmer members and their family members. I may now request Shri S. Raman, Chairman PFRDA, and Shri Shaji KV, Chairman NABARD, to exchange the MOUs. Thank you to Shri Shaji KV. Our next segment is the distribution of certificates to farmer producer organizations, FPOs, who are pension agents for onboarding of their members under NPS. With this initiative, FPOs will work as frontline supporters of NPS who will be tirelessly spreading awareness, hand-holding of subscribers, and enabling last-mile enrollment into NPS. Their work will ensure that the benefits of retirement security reaches the grassroots. We are especially pleased to acknowledge the association of Sam Unnati, a point of presence which is enabling a large network of farmer-producer organizations to act as pension agents. Through this, thousands of small and marginal to honor these FPOs who have become the pension agents as grassroots ambassadors of NPS inclusion, carrying forward the message of NPS Zaruri Hai to every village and household. May I now request Honorable Finance Minister and other dignitaries on stage to kindly come forward for the distribution of certificates to farmer-producer organizations who are registered as pension agents. I would also like to invite on stage Mr. Anil Kumar SG, founder and CEO, Sam Unnati, to join the Honorable Finance Minister for this important initiative. अब मैं एफपीओ मेंबर्स से अनुरोध करती हूं कि वो कृपया मंच पर आए. प्लीज वेलकम मिसेस रीटा रानी of the FPO Mishti Farmer Producer Company Limited. This FPO is located in Karnal. The next FPO I would like to invite on stage, and for this I would invite Mr. Kamal to come up on stage. He is representing Machroli Agri Producer Company Limited. This FPO is located in Jhajjar. I'd like to welcome Mr. Naveen Jhangu on stage. He represents Karam Raj Fruit and Vegetables Producer Company Limited. This FPO is located in New Delhi. Please welcome on stage Mrs. Veli Malar. She is representing the FPO Thiruvadanai Farmer Producer Company Limited. This is located in Ramanathampuram. Please welcome on stage Mr. Sanjay Singh. He represents Fresh Trend New Crop Producer Company Limited. This FPO is also based in Karnal. Please welcome on stage Mrs. Mamta Chauhan of Invictus Farmer Producer Company Limited, the FPO, which is based in Ghaziabad. Thank you, Anil ji. We will now release Sanchayata, a Hindi booklet which includes insights, case studies and success stories. It documents how NPS has emerged as India's trusted retirement solution and showcases the experiences of subscribers, employers and institutions who have embraced NPS. May I now request the Honorable Finance Minister and other dignitaries on the dais to kindly release Sanchayata. Thank you to our dignitaries for releasing Sanchayata. Ladies and gentlemen, we now move on to the release of the action plan for expanding NPS in the MSME sector. To begin, let's first watch a short video that outlines the clear roadmap of PFRDA in penetrating the MSME ecosystem and providing old age income security to millions of MSME employees across India.
Micro, small and medium enterprises are the backbone of India's economy. With over 6.85 crore units, employing 29 crore people and contributing nearly 1/3 of our GDP. They drive innovation, power exports and create livelihoods across the nation. To support them, the Pension Fund Regulatory and Development Authority has launched a focused outreach under the National Pension System with awareness drives, industry partnerships and a dedicated program management unit. In its first phase, it will cover 12 high-density states representing almost half of India's MSME workforce. These states include Maharashtra, Gujarat, Uttar Pradesh, Tamil Nadu, Karnataka, Delhi, Madhya Pradesh, Bihar, Rajasthan, West Bengal, Andhra Pradesh and Punjab. The initiative will reach clusters such as pharmaceuticals, automobiles, textiles, electronics and food processing, along with several other sectors across India. The goal is to onboard over 25 lakh MSME employees into the NPS by 31st March 2026, ensuring financial independence in their retirement years. This is more than a program. It is a movement to bring dignity, security and stability to millions of hard-working Indians while strengthening our workforce and advancing India's journey towards Viksit Bharat at 2047. Together, let us secure the future of our MSMEs and build a truly pensioned society.
To celebrate early adopters, may I now request the Honorable Finance Minister and other dignitaries on the stage to kindly present certificate of registration to 4 MSMEs who have recently adopted NPS for their employees, setting a strong example for others to follow. अब मैं MSME प्रतिनिधियों को अनुरोध करती हूँ कि वो डायस पर आए और अपने सर्टिफिकेट्स मैडम से लें. Please welcome on stage the representative from Vecmocon Technologies Private Limited. This is based in the Okla Industrial Cluster. The next MSME coming up on stage to receive the certificate of registration is JQR Sports India Private Limited. This is the footwear cluster in Bahadurgarh. The next MSME to come up on stage is Precision Metallurgy India Private Limited. This MSME is based in Kundli Industrial Cluster. Please welcome on stage representative from Indo-British Garment Private Limited. This MSME is based in Faridabad Industrial Cluster. Thank you. Our final segment this evening is the award ceremony for the best NPS content creators, organized under the NPS Quest Chase Your Future contest as part of NPS Zaruri Hai campaign. The contest invited reels, AI videos and creators from citizens across India, bringing innovation, creativity and fresh perspective to pension awareness. The response was overwhelming. We received 125 entries in just 5 days across the country. A renowned jury carefully evaluated the submissions and has selected the best content creators who we honor tonight. So we'll begin with the first category of Best Influencer Reel, honoring the most impactful reel that captured the spirit and retirement readiness and NPS. So in this, the runners-up is Mr. Keshav Bang, and we have another runners-up, Ms. Dimple Mittal, and the winner, Mr. Faizan Ansari. Let's watch the winning reels from these participants.
उम्र के साथू क्यों रुकते हैं जिंदगी के हर मोड़ पे नए रास्ते क्यों छूटते हैं आज के छोटे कदम बनाते हैं कल के शिखर एनपीएस जरूरी है जिंदगी भर का साथी है एनपीएस जरूरी है आने वाले कल की बात है रिटायरमेंट सिर्फ आराम नहीं एक सुरक्षा का वचन है जितनी जल्दी शुरू करोगे उतना मजबूत ये मन है छोटी सेविंग्स बड़ी ताकत जिम्मेदारियां खत्म पर जरूरतें बाकी भरोसा है जो कल का वो आज का एक इरादा है साफ एनपीएस जरूरी है जिंदगी भर का साथी है
ऑटो चलाते हो, बिजनेस करते हो, किसान हो या किसी मल्टीनेशनल कंपनी में कॉर्पोरेट जॉब करते हो। जवानी में तो सब जोश से काम कर लेते हैं, लेकिन रिटायरमेंट की टेंशन सबको होती है। बच्चों ने बुढ़ापे में साथ नहीं दिया तो ये कॉमन सवाल सबके मन में आता है और इसका एक ही जवाब है एनपीएस। आज की डेट में 1,60,00,000 लोगों से ज्यादा लोग एनपीएस में जुड़े हुए हैं। आपका प्रोफेशन कोई भी हो, लेकिन पेंशन का सोल्यूशन सिर्फ एक एनपीएस। सोचिए, आप अपनी पूरी जिंदगी मेहनत करते हो, पर अगर रिटायरमेंट के बाद पैसा ही ना हो तो डिग्निटी और इंडिपेंडेंस दोनों खत्म। एनपीएस से रिटायरमेंट के बाद इज्जत और पेंशन दोनों मिलते हैं, क्योंकि एनपीएस आपको देता है डिसिप्लिन, रेगुलर सेविंग्स और सिक्योर रिटायरमेंट कॉर्पस। तो आज ही एनपीएस में निवेश शुरू कीजिए, क्योंकि आपके रिटायरमेंट के लिए एनपीएस जरूरी है।
कछुए की तरह चलना बोरिंग है, पुजारा के जैसे बैटिंग करना बोरिंग है, फाइनेंस में डिसिप्लिन बोरिंग है, पर अक्सर बोरिंग चीजों से ही मिलता है आपको द पावर ऑफ कंपाउंडिंग। और जो स्कीम आपको दे सकती है ये पावर ऑफ कंपाउंडिंग, उसका नाम है द नेशनल पेंशन स्कीम। इस स्कीम में आप इन्वेस्ट करते हो आपके रिटायरमेंट के लिए, जिसमें आपको मिलती है फ्लेक्सिबिलिटी कि आपको इक्विटी में कितना डालना है, बॉन्ड्स में कितना डालना है, लोअर मैनेजमेंट फीस है और आपको टैक्स बेनिफिट्स मिलते हैं। और एक सबसे बिगेस्ट एडवांटेज ये स्कीम का है कि जब आप 60 साल के हो जाओगे और आपका जो एक कॉर्पस बन जाएगा, वो 60% ऑफ द कॉर्पस टैक्स फ्री हो जाएगा उसी पॉइंट पे। तो आप अभी जाइए और एनपीएस की वेबसाइट चेक करिए, जहां पर आप देख सकते हो कि आपका कितना कंट्रीब्यूशन से आप एक कितना कॉर्पस बना सकते हो, और आप जितना जल्दी स्टार्ट करोगे उतना अच्छा होगा, क्योंकि एनपीएस जरूरी है। चीयर्स। कछुए की तरह चलना।
Our next category is Best AI Video, celebrating the most creative use of AI to explain NPS as India's pension solution. Here the runners-up is Mr. Sonu Singh and Mr. Shahid Khan, and the winner is Mr. Vishal KP. Let's play the winning videos.
आज हम जो मेहनत करते हैं वो सिर्फ अपने लिए नहीं, अपनों के लिए भी होती है। जिंदगी भर परिवार ही पहली जिम्मेदारी है, लेकिन उम्र ढलने पर कौन साथ देगा? एनपीएस के साथ कल की चिंता नहीं।
माँ ने अपना कल सुरक्षित किया एनपीएस के साथ, और आज मैंने भी सही फैसला लिया।
नेशनल पेंशन सिस्टम, अपना आज भी सुरक्षित, कल भी। एनपीएस जरूरी है। We work hard every day for our family, for our dreams, for our future. But have you planned for the life after work? Without planning, retirement can feel uncertain. But with the National Pension Scheme, every effort today turns into financial freedom tomorrow. Start early. Let compounding multiply your savings and ensure dignity and independence when you need it most. NPS is not just an option. It's a responsibility towards your future self. Whether you're a teacher, a doctor, a worker, or an entrepreneur, there's one pension for every profession. Secure your tomorrow, because dreams don't retire, but salaries do. That's why NPS ज़रूरी है.
A cup of coffee every day for 100 rupees. Sounds small, right?
But what if you invested that same 100 rupees daily into NPS?
Fast forward 30 years. One has only coffee memories. The other enjoys a retirement corpus of lakhs. That's the power of starting early. Compounding works silently, turning small savings into big freedom.
Our next category is Best Creative Poster Design, recognizing the most powerful creative design on poster that spread the message NPS Zaruri Hai. Our runners-up are Mr. Kuldeep Parashar and Ms. Dimple Mittal, and the winner is Mr. Siddharth Sehare. Let's take a look at the winning posters. Please give a round of applause to all the winning entries. May I now request the Honorable Finance Minister and the dignitaries on stage to please present the certificate of appreciation to the winners on stage. I would like to invite on stage Mr. Faizan Ansari, who has the Best Influencer Reel. Please give a round of applause. Please welcome Ms. Dimple Mittal, runners-up, Influencer Reels and Creative. Please welcome Mr. Keshav Bang, runners-up, Influencer Reels. Please welcome Mr. Shahid Khan, runners-up, AI Video. Please welcome Mr. Sonu Singh, runners-up, AI Video. Next is Mr. Siddharth Sehre, Best Creative. And Mr. Kuldeep Parashar, runners-up, Creative. Ladies and gentlemen, please join me in congratulating these talented creators for their remarkable contribution to the cause of pension awareness under NPS. Ladies and gentlemen, we have now come to the moment that we all have been eagerly awaiting. It is my proud privilege to invite our chief guest, Srimati Nirmala Sitharaman, the Honorable Union Minister for Finance, to deliver the keynote address. Please give a huge round of applause to Srimati Nirmala Sitharaman.
Good evening, and let me start with a little apology that I was a bit late. We had a GOM and that overshot the time, so I had to reach here a bit late than what I was scheduled to. First, if I can start on a lighter note, and I'm sure all of you all wouldn't mind me sort of digressing a bit from the topic. I'll certainly talk on the topic. I must appreciate Raman for one thing. On a subject like pension, in an evening which is just about an hour's program, hour and a half at best, he squeezed in the maximum things that you can say about pension. It trained the pension schemes. Each one had something to offer. Congratulations to all of you all. It's so thoughtful that you could design and launch a scheme which is brilliant. I welcome that. But here is Raman after that, reining in his awareness campaigns. And rightly, rewarding, recognizing those young people who've done these wonderful new ways of promoting pensions. So it's not easy. You would expect to come, be welcomed, and then after that distribute some pension scheme certificates. And it's very thoughtful and very, very inclusive to have brought in the gig workers. HDFC, congratulations on that. It's a very good way of bringing in. So for me, normally you go to a program, you know you're going there like an arrow doing what is meant and then rushing off. Here, did it surprise you all that you can do so many things on pension? So once again, congratulations to the Chairman PFRD. And a special word of thanks for all those influencers who've done reels, who've done posters, who've done campaigns to make this subject in a bite-like size attractive, and people would want to see what it is. That the particular thing about the bus stand where the advertisement says, bus aayega ki nahi aayega, aapka retirement to zarur aayega. I mean, these are absolute, plain and simple creative thought. So it's so refreshing that you can have newer ways of promoting pension. In this country, I'm talking like one of all of us. Pension, medical insurance, insurance of any kind for that matter, life, are not topics which people can talk as though like, hey, we are going out to eat today, or we are getting a ticket to see a film. As a family, all of us are going. They're still muted. People realize what it can do to you, pensions and insurance coverage, but still they are muted. But today's program gives me hope that even this can be made lots more catchy and involved and attractive. Therefore, you can spread the word better and have more people come in. The one other thing on which, much before I get to talking the unglamorous side of talk, is I was very impressed that you have reached out through an agency, whatever, farmers, FPOs, women in those FPOs, and for them to feel more institutions participate, more PFRDA looks at it as more as a regulator rather than performing both promotion and regulation. I think they've done that, distancing themselves a bit. So it is nice to see that we are looking at various different ways through which we are promoting pensions. So, as India moves with a purpose towards Vikasit Bharat 2047, I think every citizen can now hope to have financial dignity in old age. I find this argument justifying pension a bit retrograde when we say, what happens if our children don't take care of ourselves? No, I don't think that should be the route. Your children can take care of yourselves, but still you need to have that financial independence and to have that dignity that you also have your own resource through which you're planning your retirement. And therefore, it doesn't have to be when children are bearing with you or putting up with you or taking care of you or not. I think pension is important for old age. And there should be very many options, and today the options that we saw has really made me feel this sector is now getting a full-fledged robustness, which is so much desperately needed for a country like India, because being jaded or being, a bit more like what it was earlier doesn't help anymore. Every sector has to be a lot more creative and imaginative about which they can go about. And I think in that, the pension sector has now crossed the threshold, and I think this augurs well for this sector. A strong pension society actually matters. Not only the sense of security it provides for old age, I think it strengthens households that are changing in form and aspiration, about which Secretary DFS spoke. It eases pressure on working age children in cities and small towns, and it channels long-term savings into national priorities. Each of this is absolutely important. And the population statistics was already given, but I want to reiterate for the sake of my media friends. United Nations Population Fund, India, it says that India is aging, and in its report called India Aging Report 2023, predicts that our 60+ aged population is rising from 10.5% in 2022 to 20.8% by 2050, doubles the number. And by 2100, which is 2100 year, seniors could be 36% of our population. Niti Aayog in 2024 estimated the number of elderly growing from 10.4 crores in 2011 to 31.9 crores by 2050. So we must plan, and there's no second thought on it. Joint families are giving way to nuclear ones. Households, and as mobility rises due to urbanization and opportunities in different cities, this is even more fragmenting. Modern aspirations for retirement will also go beyond mere subsistence, because our middle class and our growing middle class is just not wanting to make bare subsistence like provision for its future. There are many more aspirational points getting built in it. And the traditional model of a single lifelong job with a defined pension is also becoming rare. Today's workforce is characterized by job mobility, entrepreneurship, and the rise, as we saw, in the gig economy. This makes employer-sponsored pensions less reliable for an entire career, and therefore placing the onus on the individuals to build their own portable long-term retirement plans. So as the wage-earning laborers or salary-earning class and their job profiles change, our pension planning also has to be so much flexible. The introduction of the NPS in 2004 by the then NDA government brought a crucial transition from defined benefit to a sustainable defined contribution pension framework. So the NPS transformed retirement planning from a government sector privilege into a universal tool for financial security. I think that marked a big difference, that only government workers are entitled to pension. The private sector never gives. Changed a lot from then. And I think initially available to government employees in 2004, NPS has been progressively extended to entire private sector for all citizens. And NPS is one of the lowest cost pension fund management schemes in the world. Lowest cost pension fund management. Lower cost means most money stays invested and grows. It doesn't get passed on to the service which is being provided, but it is getting invested and it also grows. NPS offers flexibility and choice. NPS, the architecture itself is safe, transparent, and it's also very regulated. It also offers seamless mobility, moving seamlessly throughout one's career. And that is why it's a very interesting thing that 3 years ago, probably on this very same day, we launched the NPS Vatsalya. Now, seamless is not from the top, from the time you've got a job and then on till your retirement. It's actually brought it backwards. For a child who's born NPS Vatsalya, even with varying amounts, with the gifts being given to the child, all being invested into NPS Vatsalya, when the child reaches 18, or when the child gets a job, this transitions into the pension fund, and therefore you have a lead advantage over those who have not joined the NPS Vatsalya. So you see the way in which pension can aggregate little things into a large pool, which itself is an advantage for an individual. So NPS provides lower threshold of entry. It also remains active only with an annual contribution of just 1,000 rupees. Also, it's not necessary to contribute every month, offering flexibility. So this is where it suits let's say, gig workers. It suits anybody else who's got this volatility about the job, steadiness of the job, notwithstanding, you're still being able to remain in the NPS. In 2024, direct remittance facility was enhanced to ensure that NPS subscribers receive the same day net asset value for their investments. I think this is a very market-driven, but yet makes it attractive possible alternative which was brought in. And this eliminates the risk of losing out on potential gains due to processing delays in rising market. I mentioned about the NPS Vatsalya. For minors it was launched. It has crossed 1.5 lakh enrollments already. But I would think this number needs to grow. We need to have a lot more drive to promote NPS Vatsalya, that a small regular contribution can accumulate meaningfully over the years. The schemes under NPS have generated attractive returns. This is very important, and I think the media should give a special attention to it. All my media friends who are here probably are hearing it. I'll request them to listen to this point very much. The average annual returns since inception under NPS for equity schemes of NPS have been over 13%. I think it's an absolute attractive number, 13%, and around 9% of for both corporate debt schemes and government security scheme. So either you look at equity or you look at debt, the returns are absolutely well and above what is otherwise prevailing in the market or for other schemes. Coordination across India's larger pension landscape is also equally important. In the budget of 2025-26, it was announced that a forum for regulatory coordination and development of pension products will be set up. Accordingly, in August 25, we have set up the Forum for Regulatory Coordination and Development under the pension products. It brings together the PFRDA, the EPFO, the IRDAI, and the SEBI and relevant ministries together. So this would be a lot more nimble and robust body to take care of inter-departmental or inter-regulatory issues. The main aim of such a forum is to develop a common regulatory and supervisory framework, investment standards across pension products, strengthening consumer protection, grievance redressal, and ensure robust systemic risk management of assets under management. Of course, there's a larger objective. And the larger objective is to harmonize investment and disclosure standards, enable portability across pension products, strengthen consumer protection and grievance redressal, manage systemic risk across AUMs, that is the asset under management, support product development and pension awareness. Stakeholders and consultations are underway. The objective is to be predictable, citizen-centric pension market with clear rules and seamless services. With effect from 1st October 2025, that is today, the multiple scheme framework is on. The non-government NPS subscribers will be able to allocate up to 100% of their funds in equities. Each scheme will have moderate and high risk variants with equity exposure permitted up to 100% compared to the current 75% in high risk options. So this will bring in a major change in which these funds can be managed. An investor would be able to choose the new schemes under MSF without needing to invest in the common schemes. So that's a major change. The old schemes of various pension funds, the common schemes which belong to the old schemes of various pension funds. Non-government subscribers can also opt for the multiple schemes across different CRAs. The CRAs, I'm sure you're familiar, are the central record keeping agencies. Under a single permanent retirement account number. So you're able to get that one single permanent account number, and you're now able to look at various multiple schemes which are being offered through the central record keeping agencies. So it will cater to different investor preferences, giving them greater flexibility. The cost structure also continues to remain low, capped at 0.30%, 0.30% of assets under management annually. And with an additional 0.10% incentive for PFs that bring in new subscribers. So for subscribers, the MSF scheme represents a major expansion of choice and personalization. So getting closer to finishing, I would like to say the way forward for NPS and pensions. I have about 6 different points which I would like to put before you all for your consideration. Broaden the coverage to informal, self-employed and platform and gig workforce by simplifying the onboarding requirements, offering local language interfaces and enabling doorstep or let's say the eKYC, so enrollment can be quick, can be easy, can be trusted. So that's my first of the 7. The second is deepen women's pension security. And that can be through workplace auto-enrollment, contribution continuity during maternity and caregiving periods, and micro auto debits that keep small regular savings from from lapsing. The third of the 7, embed financial literacy early in schools, in ITIs, in colleges and community centers, so households can begin contribution in their 20s or just before 30s, and compounding works through the entire working life then. So NPS should run into or call itself into a true Jan Andolan. It will actually mean that if you start doing, early, going into ITIs, going into schools, going into colleges and so on. So we should convert the intent into action for the benefit of crores of families. The fourth of the 7, I said 6, hold costs down and lift service quality, which is important because you need to be time-bound, digital by default. Grievance redressal should be digital by default, clear disclosures, and portability that works seamlessly across products. Keep the system fiscally sustainable. That's one very important point, because by aligning contributions, prudent asset allocations, inflation-aware benefits, so pensions remain reliable across economic cycles. So I want the DFS and also the PFRDA to explore, can we train women as pension Sakhis? Because insurance Sakhi launched through the LIC became a major hit. Now Bank Mitra are also expanding through the Nari workforce. So more and more banking correspondents are coming as Sakhis for banking services. I would think the pension should also benefit if we train women as pension Sakhis and incentivize them for sustained increase in enrollment, much like the Bima Sakhis, as I said a minute ago. So in conclusion, I'd like to say planning for retirement enables self-reliance, enabling individuals to maintain control over their lives, health and choices. This embodies the essence of Atmanirbharta at the household level itself. So if you want Atmanirbhar Bharat, you need to have Atmanirbhar households. The growth of any nation depends on the robustness of the social security framework that we provide them, and therefore with pension and retirement solutions coming like this, they should occupy the centerpiece. The recent reforms that we have announced will help address the supply and demand side of the pension framework from the industry and also from the consumer standpoint. So the fiscal gains of robust pension system are actually real. Domestic savings deepen and capital can be used for long term. But the human gains are deeper is what I would like to conclude with. Fewer families pushed into distress by an illness or a loss of income in old age, and more seniors living with agency and not dependency. Therefore, I think the Pension Diwas or NPS Diwas has begun well. A slew of schemes are now made available. It's for us to spread the word and make sure that every Indian, as he ages, has the sense of security and dignity. Thank you very much.
Thank you, ma'am, for your visionary address. Indeed, Atmanirbhar Parivars will become the foundation of Viksit Bharat. To formally conclude today's plenary, may I request Ms. Mamta Shankar, whole-time member Economics, PFRDA, to please deliver the vote of thanks. Please give a round of applause to Ms. Mamta Shankar.
Honorable Union Minister for Finance and Corporate Affairs, respected Secretary DFS, Chief Economic Advisor, Chairperson PFRDA, distinguished invitees of the dais, esteemed guests, colleagues, members of the media and friends. It is both an honor and a privilege to propose the vote of thanks upon the conclusion of this truly momentous NPS Diwas, which has laid the foundation of insight, innovation, and impactful dialogue on the future of pensions and old age security in India. Let me begin by expressing our deepest gratitude to the Honorable Union Minister for Finance and Corporate Affairs for gracing the occasion with her presence. Ma'am, your words today have infused impetus to our collective and unwavering commitment towards building a robust and inclusive pension framework and inspired us to strive even harder towards our goals. PFRDA is committed to meet the expectations for building an inclusive pension society aligned with the vision of Viksit Bharat 2047. Our sincere thanks to Secretary Department of Financial Services for elaborating the pension context today and for his constant support and encouragement to PFRDA is invaluable. We are also thankful to Chief Economic Advisor for his special address, which brought economic insight and comfort of robust macroeconomic framework for the pension sector. We also extend our gratitude to our chairperson, PFRDA, for steering towards new frontiers. Our heartfelt thanks to our distinguished invitees of dais who have taken out time for today's evening, and to all the pension funds for their vibrant launches, participants in our panel discussions today in the afternoon preceding this session, newly onboarded pension agents, brand holders from platform and MSME clusters, FPOs, Zomato platform partners, Samunati, CRAs, POPs, other intermediaries and winners in the context, our collaborators and colleagues. Your enthusiastic response and participation in today's session has set a powerful tone for NPS Zaruri Hai, one of vision, inclusivity, action, and collaboration with creativity. Thank you.
Thank you, ma'am. Ladies and gentlemen, this concludes the plenary session of NPS Diwas. Please give a huge round of applause to our dignitaries on stage. We thank them for coming here and for encouraging all our participants who've come up, our MSME partners, our FPO partners, the influencers. I request everybody to remain seated so that our dignitaries can exit. On behalf of PFRDA, we extend our heartfelt gratitude to the Honorable Finance Minister, dignitaries and all participants for making this evening truly memorable. We now invite all of you to join us for dinner, which is being served immediately after this session. Thank you all and wishing you a pleasant evening ahead.